Good morning, everyone. It's 9 a.m. here in New York City. I'm Brad Smith alongside Shauna Smith, and this is Yahoo Finance Live. Here is what we're watching this morning. Rally on. Market surging on the clearest signal yet from the Fed that rates have peaked. The fervor going global, lifting European markets in spite of the Bank of England's more hawkish tone.
And strong data out this morning may throw a wrench in things. Retail sales rebounding month over month ahead of estimates and signaling a still strong consumer. This as jobless claims falling to a multi-month low, more than expected.
And House Republicans formalize an impeachment inquiry against President Biden, but impeaching the president may not be the goal. So what ultimately is? We'll have more on that.
Well, we have been dissecting a lot of economic data this week. Retail sales coming in this morning above expectations, up 0.33% here, 0.3% last month, ultimately signaling that the consumer remains resilient this holiday shopping season. When you take a look at that move to the upside, obviously, once again, Brad here pointing to the fact that we are seeing a very resilient consumer, and this coming at a time where we know consumer spending is so critical here to the economy, to many of those retailers' consumer discretionary plays as we count down to the holidays. But 8 out of 13 categories posted increases this month, led by restaurants and bars, sporting goods stores, and also online retailers. We did see a bit of a decline here in department store sales, not necessarily a huge surprise when you compare that to some of the recent earnings reports that we're getting from a lot of those department stores, or even the news headlines coming out over the last several weeks in terms of some of the troubles that they are up against. But again, the big takeaway here is that the consumer remains resilient. They remain strong. They're spending, and they're doing this all in the face of what is proven to be relatively sticky inflation up until this point.
Oh, yeah, absolutely. You mentioned some of the key areas, and the month-over-month and year-over-year advance in some cases tell a very different story, even though some of the trend still continues to be key to watch. And most notably, I think about furniture and home furnishing stores, because at the end of the day, they're still down 7.3% compared to last year, cyclically, or at least month over month, I should say. They did move higher just a hair by about 0.9%. But then ultimately, some of the other areas that have continued to show weakness in the broader trend, but over month moves that we have seen higher here. Most notably, you're taking a look at some of the areas like clothing and clothing stores here. Actually, month over month, year over year, both of those moved higher by about 6% for clothing and clothing accessory store. Key part of the year where any of those retailers, you're taking a look at retailers and department stores on your screen right now. Department stores actually moved lower, both year over year and month over month. So still looking for a bottom there within that particular part of this report.
Yeah, and we're also squaring this with the jobless claims number that we also got out this morning. Once again, proving the fact that the jobs market remains relatively strong up until this point. Claims data falling to 202,000 for the week that ended last week, a decline of about 19,000 from the prior week, coming in lower than what the street was looking for. So you also have to ask the question is whether or not all this optimism around a soft landing, all the optimism around the fact that the Fed could potentially cut rates as early as March, whether or not that's warranted given the fact that the economy remains so resilient.
Yeah, absolutely. Well, investors are loving Federal Reserve Chair Jay Powell's remarks of where the economy is heading. The Fed penciling in 3 rate cuts in the new year, with inflation now expected to trend down to 2.4% by the end of next year. Now, a few things are important, and this is kind of the report where we were expecting even more of that update on the dot plot. I'll save that for you. I know that you've been hot on the dot plot, but one of the things that really jumped out to me within the press conference that took place was actually in response to the labor market, because saying that it continues to remain tight, supply-demand conditions continue to come into better balance. Past 3 months, job gains for payrolls have averaged about 204,000 per month. So what has to happen? FOMC participants actually expect the rebalancing in the labor market to continue, easing upward pressures on inflation. And here's what they're forecasting for next year. By the end of next year, 4.1% unemployment rate. And that is their projection. That's going to be something that we're kind of benchmarking against here.
Yeah, you mentioned the dot plot there. I think it's all about that when it comes to those expectations, squaring that to what the street is expecting. The big surprise, and I think it did catch the market a little off guard, we saw that in the reaction in March markets yesterday in terms of some of that optimism. The Fed now seeing the potential for 3 rate cuts next year. The market, though, is still even more optimistic than that. They're still pricing in about 6 rate cuts for next year. So, of course, we got to ask whether or not the market is being still too aggressive up until this point. But the fact that the Fed now sees the potential for 3 rate cuts next year, some of the commentary, some of the rhetoric that we heard from Fed Chair Jay Powell yesterday saying that they've almost reached a turning point at this point, that the discussions have started as to when the Fed could ultimately cut rates. We haven't necessarily heard that as directly as he put it yesterday, which is, of course, what was fueling the rally, and we'll see whether or not some of that optimism holds today.
Yeah, on those rate cut expectations from the market, it seems like the hopium is running a little high right now. Well, Wall Street and the Fed, they are on the same page, kind of, for the first time in a long time. Market expectations and the words of Fed Chair Jay Powell largely harmonized, and the Fed indicating multiple cuts are coming next year, though also warned it's far too early to declare victory. Shares spiked, bonds surged, global currencies rallied. Anyway, are we getting carried away here? Joining us with the latest, we've got Yahoo Finance's Jared Blickery. Jared, a man who rarely ever gets carried away, but without, well, for a good reason he does. But is this a good reason to get carried away, Jared?
I was truly shocked by yesterday. You look at the net result, we got the Dow at a record high, Apple at a record high, the 10-year under 4%, job done. I think we can just sail into the new year, right? Well, there's a Bank of Japan meeting next week, and so that's something every investor should have that on their radar. But that's probably going to kick the can into next year. And in the meantime, we just have incredible bullishness here. Now, regarding the FOMC and Jay Powell, I want to show a chart of the yield curve, how it has shifted south over the last about month and a half. There you can see October 19th is the top line, and you can see it was pretty flat there. And now December 14th, that's that cyan line at the bottom. That is a tremendous drop. We're looking at drops of over 100 basis points in some of those tenors, especially the belly of the curve. So incredible bullishness coming out of that report. And then when you take a look at the rate cuts, I have another chart here. We are pricing in now 7 rate cuts through the first month of 2025. So basically 2024 plus 1 month. And those rate cuts, that's up from about 3, and that was only as of October 31st. So a lot has been done here. A lot is priced in. And is it realistic? Well, at this point, it's too early to tell. But Powell, by his refusal to really, I'm at a loss for words here. I'll just say this. If we can go back to the Wi-Fi Interactive, I'll chart some of the market action here. And here's our record highs year to date. There's Apple front and center up 52.4%. Just give you a quick look at the 5-year. You can see what a bullish chart there. And even at the worst in 2022, wasn't down that much. And we just had a minor correction here, and we are back up to those record highs. I'm going to rattle off some names real quickly here. Apple, Visa, Broadcom, MasterCard, Costco, T-Mobile, ServiceNow, all of those are at record highs. And then you take a look at the sectors, SMH in the upper left up 67% this year. That is a chip stock ETF. Then we have XLK, that's all of tech. We got home builders, infrastructure, that's pay right there, even European financials. So the party has spread worldwide, and we're looking at the bullish outcome right now.
We certainly are. We're seeing that euphoria carry over here in early trading. We're ahead of the opening bell here this morning. Jared, thanks so much. Well, we have been hit with a slew of data to end 2023, from a jobs report that showed a still robust labor market to cooling inflation prints, a more dovish Fed, and retail sales this morning showing that once again consumers remain resilient amid the holiday shopping season. Sales for November rising 0.3% on a month-over-month basis, where a dip was expected. So is it too early to claim victory over a soft landing scenario? We want to bring in Greg Dacko. He's EY chief economist. Greg, it's great to have you here in studio. So I think investors are asking themselves this morning whether or not we're in the clear, if a soft landing is a sure bet at this point. What do you think?
Well, I think for 2023, that was the key question. Are we going to be able to achieve that soft landing? I think we largely have achieved it for 2023. We've seen an environment where inflation has come down within reach of the Fed's 2% target, and we have not seen the recessionary signals that were once feared at the start of the year. The question for next year is whether that soft landing can be sustained. And I think some of the easing signs from the Fed in terms of its pivot are encouraging in that sense, but we have to be careful. Cost fatigue and the labor market developments will still be the key drivers of economic activity as we navigate next year.
I mean, we were talking with CEOs and one analyst yesterday of the retail sector just about where the state of the consumer is. Does it feel like as the consumer is becoming even more cost conscious that we are already seeing some of that, or value conscious, I should say, in their words? Are we already seeing cost fatigue start to show up?
We're absolutely seeing cost fatigue. I mean, that's the big disconnect between how the economy is doing and how people are feeling. Consumer sentiment, business sentiment is quite depressed in this environment, and yet the economy is still moving at a decent pace. It is slowing, but it is still moving forward. I think that cost fatigue, whereby the cost of everything is much higher than it was pre-pandemic, is affecting how people feel and how they feel they're able to spend going forward. We're still seeing, as we saw in the retail sales data, that people are still spending more dollars. They're being a bit more cautious as to how many goods, how many services they purchase. I think that's going to be the key story as we go into 2024. And the key backdrop, the key anchor to a soft landing is a labor market that does not retrench. So far, we haven't seen the type of retrenchment that precedes a recession. Is that going to last?
So, Greg, with all of that, then I guess what is your projection or what is your outlook or expectation right now for the Fed to cut rates? Because the Fed here signaling that maybe 3 cuts are on the table for next year. The market's still even a bit more optimistic than that. What do you think is realistic?
Well, I think the Fed's candid pivot towards the fact that it will be adjusting monetary policy was very important. Now that's behind us. This acknowledgement that inflation has been falling faster than initially anticipated is a very good development. Now the Fed will have to calibrate how rapidly and how much it cuts rates. But that first step is behind us, which is a good thing. It's a realignment with the reality of today's economy, an economy that is gradually slowing, where there's a rebalancing taking place between labor supply and labor demand, and where inflation is falling back to a level that would be less of a concern for the average day business leader and consumer.
With the number of cuts we've seen at the end of this year, is that a concern at all for you when you think about the broader labor market picture right now?
I think we have to be a little bit careful with the market pricing of rate cuts. The Fed is not going to be in a hurry to cut rates very rapidly unless there is a recession. And as I mentioned earlier, it's important to remember that labor market dynamics and cost fatigue are still going to be the key drivers of economic activity. There was a lot of rate insensitivity on the way up when the Fed was tightening. That's why we're not in a recession. We have to be conscious that on the way down, when the Fed is easing, there will also be less sensitivity to that easing. And so the euphoria about this soft landing and this environment where we're not going to see any slowdown perhaps is overdone. The Fed is not going to be slashing rates very rapidly.
Yeah, and Greg, to that point, Chair Powell did couch it a little bit just in terms of the fact he didn't fully rule out the potential for another rate hike down the line, very data dependent. Do you think another rate hike is totally off the table at this point?
We've been saying for a long time now that the Fed was at the terminal rate. It was pretty clear that there wasn't going to be the necessary increases in inflation that would push the Fed to tighten monetary policy further. I think we've seen that monetary policy is sufficiently restrictive to bring down inflation back down to the 2% target. I'm in the camp that the last inflation mile will not be the most difficult. We're seeing a number of elements that show that the disinflationary momentum is quite strong. We're seeing it in the CPI data. We're going to see it in the PCE data. We've also seen it in the PPI data in terms of margins. Wage growth is easing. And let's not forget, yes, there's a lot of hope that the Fed will cut rates rapidly, but monetary policy today is still very restrictive.
You mentioned in your notes, Fed Chair Powell appeared much more dovish than he has been in the past. What's it going to take for him to be able to bring some of the more hawkish remaining members over to his side?
Well, I think the key element in his statement was that the Fed is going to be considering rate cuts. It was acknowledging the obvious, something that most participants were pricing in, that the market was pricing in. Now we can move on to the calibration discussion. How many rate cuts and how rapidly should policymakers cut rates? I think one of the key dimensions that we've not seen in a while from the Fed is dissents in terms of the common view. There has been this consensus approach to policymaking whereby there haven't been any dissents to the votes, even though some policymakers may not necessarily have been in line. That's very different to what we're seeing at the ECB, at the Bank of England, where there are opposing views. We may see a little bit more of that as we move into 2024, because if you look at the dots in the dot plot, not everybody is of the same mind when it comes to how much easing is necessary over the next year.
Love that dot plot. My goodness. Greg Dacko, who is the EY chief economist, joining us here today. Thanks so much for the time. Always appreciate it, Greg.
Thank you.
Well, the House has voted to launch a formal impeachment inquiry into President Joe Biden. The resolution passed along party lines, 221 to 212. The three GOP-led committees have been investigating the president and his son Hunter for months. The White House recently stating subpoenas issued as part of the investigation were illegitimate without a formal inquiry. So, a formal inquiry was then launched. House Majority Whip Tom Emmer made it clear that President won't necessarily be impeached as a result. So, what are lawmakers hoping to gain from this latest political move? Joining us now to discuss is our very own Rick Newman, alongside James Carville, who is the political strategist and host of the Politics War Room podcast. Great to have you both here with us today. James, I'll go to you first. What are they looking to achieve by an impeachment inquiry and proceeding, perhaps?
Well, they asked some dope congressman from Texas what to achieve, and he said Donald J. Trump in 2024, baby. So that's about the depth of the reason behind this idiocy. And these people are just not very talented and not very smart. And my own theory is the more they're out there, the better it is for Democrats.
Hey, James, what is the political calculation here for these Democrats? So it seems like they are trying to distract attention from Donald Trump, who's in these 4 criminal cases. Is there any chance that's going to work?
You mean the strategy of Republicans, right?
Yes.
Yeah. I don't know. I mean, they have to keep, they have their base and they have to keep feeding that monster. And they don't have I don't know, there's absolutely no connection to President Biden to any of this. There hasn't been one single shred of evidence that connects him. So we're going to have a hearing to determine that Hunter Biden engaged in some questionable activity. Gee, what a surprise. Knocking me over with a feather.
James, is all of this just about the re-election in 2024? And when you take into account maybe some of the expectations here, what the Republicans are hoping is going to happen as a result of this, is that just totally unrealistic?
I think it's about they haven't done anything. There's no prospect they're going to do something. And I think when they go back home, they got to say, we did something and we voted to open an impeachment inquiry. I think that's what's at the core of all of this. And also what, as I repeated, what this idiot congressman said, Donald J. Trump in 2024, baby. I mean, I don't think it's really complicated.
James, let's telescope out from this. Putting this whole thing aside about impeachment, I mean, President Biden is struggling anyway. I mean, polls show in some cases he's losing to Donald Trump in those swing states that are going to determine the winner in 2024. Now, obviously, polls 11 or 12 months ahead of time don't tell you everything. What can Biden do, though, to improve his standing among swing voters in swing states?
Well, I've been troubled. I mean, I'm pretty public that these poll numbers are troubling. The theory is, I mean, if you look at the economic stuff here and watch Yahoo, the income numbers are starting to be a little more robust. And the hope is that this recovery gets stronger, attitudes will change. But right now, they're not very good. There's no way to spin this any other way. Then these pollings are quite alarming at this point.
Well, James, why do you think there is this disconnect, right? Because when you take a look at the data that we've gotten recently, it has shown that we have gotten a better handle on inflation. The jobs market has remained much more resilient than many of the forecasters had anticipated, yet President Biden is still struggling in the polls. Why do you think that is, and how much of this is just a messaging problem?
Well, the answer is no one knows for sure. What concerns me the most is age might be an opaque factor that a lot of the public can't see beyond that. I don't know how you prove that to be true. And maybe it just takes a while because inflation took such or cost of living took such a bite out of people that it takes a while for it to catch up. That could also be true. But the precise reason behind this remains unknown to right now.
And so, James, just lastly, while we have you, you think about some of the other kind of shadow campaigns that are being running for that potential party nomination. Should age be so much of a factor that each party says, okay, we should not have Trump as our figurehead. And then ultimately for the Democrats as well, if age is a considerable factor and Joe Biden only running because Trump is running again, then is there another type of ticket or matchup that we could be set for in 2024?
Well, one thing we know for certain, the public does not like this choice. They're very clear. I think it's over 70% would like to have a different choice. And, you know, that's 334 million people in America. And people say, well, we can't come up with two people who run for president under the age 75. I don't know, but that you can look at poll after poll that the public would prefer a different choice. Now, what I'm told by people smarter than me, well, this is the choice you got, so live with it. And at some point that may be the case. But it's clear that this is not a choice that the American public wants to make.
James, as you know, it's the economy stupid. Is there anything a president can do to persuade voters that the economy is better than they think it is?
It's the most difficult question in politics, honestly, because if you try to take credit for a good economy and people don't feel it, then they think you're clueless. I can't tell you the awful economic predictions that is made by the economic forecasting community, frankly, a lot of it on this network over the past year about how things are going to be bad and how disastrous it was and recession waiting to happen. And maybe some of that filtered down to people. But I can't think of an industry that has a worse track record than economic forecasting had this year, honestly. I mean,
Pollsters in 2016.
James Garble, it's always great to get your insight here. Thanks so much for taking the time to join us here this morning. And I have a feeling we are going to be talking to you a heck of a lot here over the next 12 months. James, thanks.
Thank you very much. I hated to be mean, but I had to get to dig in.
Let's get to another top story that we are watching here this morning. Warren Buffett backing Occidental's latest deal. Berkshire Hathaway scooping up another $590 million worth of Occidental this week, upping its stake in the company to 27%. Now, this buying activity following Occidental's agreement to acquire Crown Rock in a $10.8 billion deal. So Warren Buffett has been slowly adding to his position of Occidental here over the last several years. This move here from Berkshire Hathaway coming on the heels of that deal. We have seen consolidation within this space, within the energy sector. Buffett at least thinking that maybe Berkshire Hathaway more broadly thinking that, hey, this deal makes a lot of sense here for Occidental and makes it even more attractive in the longer term.
Yeah, this is still less than 4% of his entire portfolio. Apple really holds kind of the lion's share, roughly, or just under 50% of the entire Berkshire Hathaway holdings. So all of this considered, Occidental has been one of the big bets. It's been ripe for the investment that Berkshire Hathaway has kind of charted forth this pathway forward. And ultimately now it's a larger question of, within the energy space, are there more acquisitions, more mergers that see further consolidation? And how does Occidental Petroleum kind of position itself within that realm as we move forward in 2024? That's the question that we've continued to ask analysts, whether or not they see more M&A in this space, especially considering what's already come into the fray. You think about some of the larger names, Exxon, that have found themselves squarely within these merger and consolidation discussions, Hess as well. And so there have been some big names within oil and gas and energy as a whole, but does 2024 hold the same type of deal-making activity? And I think that's a larger question that Occidental is going to be trying to figure out too.
Yeah, certainly. Well, Berkshire Hathaway's total stake in Occidental now right around 27%, but I think the fact Berkshire even buying more shares of Occidental really just signals confidence that they have in this name at this point. All right, we'll keep right here on Yahoo Finance. We've got all of your market action ahead. Stay tuned. We'll be right back. This morning, Pfizer completing its acquisition of Seagen after receiving all regulatory approvals. The pharma giant acquiring the biotech company focused on cancer medication for a value of $43 billion. For more on this, we want to head down to the floor of the New York Stock Exchange. Madison Mills standing by for us. And Maddie, we have seen Pfizer stock get hit numerous times here in recent months. Is this going to be enough, do you think, to turn around some of that downward momentum?
Yeah, I mean, those earnings yesterday were really tough for Pfizer. Towards the end of the day, they were heading near their decade lows as we headed towards the close. And this morning, seeing a little bit of recovery to this name, but it's not enough. That acquisition of Seagen, not enough to push this stock forward. And guys, as you can see here at the stock exchange, it's a busy morning as we get close to the opening bell here, but a tough opening for Pfizer. I just want to take a quick look at where this name is heading into the opening bell. They're up about 0.9% this morning, but trading on pretty low volume. Again, seeing a lot more movement in this stock yesterday after those negative earnings. They're saying that the COVID vaccine, as we've been talking about, has not continued to be a boon for this company. And that news also brought down some of the other names that we know of in the COVID vaccine space, companies like Merck, for example. The real takeaway for me here is that these biotech plays are going to continue to be part of the story for these other healthcare names as we head into 2024. We've heard from multiple analysts that these biotech companies could potentially be part of that broader rally heading into next year as we look to some of the smaller cap names for growth. And this acquisition of Seagen could be one example proving that theory heading into the new year.
All right, a lot to continue to track going into the opening cross there. Thanks for joining us, Yahoo Finance reporter Madison Mills. Appreciate it, Maddie. Well, let's take a look at the futures here this morning. We're taking a look at some moves to the upside. Of course, retail sales as well as jobless claims, two of the economic data points that the markets have at least a snack on for breakfast this morning as we get closer to the start of today's trading activity. I personally prefer a bacon, egg, and cheese sandwich, but hey,
Me too.
Economic data for some people just gets it done. Dow Jones Industrial Average is looking at gains of about 0.4% right now. S&P 500, that's up by about 0.4%, and the Nasdaq futures up by about 0.3% as well. Just to run back through some of these numbers that we had seen come through in the form of retail sales here, because ultimately there were a few categories that we started to dig into ultimately, and the advance in monthly sales, we saw that move higher by about 0.3%. We got an October revision as well. That was actually down 0.2% here. And so as we look forward to that next release that's going to come in January 17th here, I think more broadly after this holiday season and looking through some of those categories where consumers are still pushing back on price or just so sensitive to where discounting is actually taking place so that they don't have to incur those full prices that they would typically pay, I think it continues to show just what we had heard from the StockX CEO, Scott Cutler, yesterday, that this is a more value-conscious consumer at the end of the day.
It's a much more value-conscious consumer. I think that has been reflected in recent earnings reports, also reflected in the retail sales data that we got out this morning. They're still out there spending, but they're thinking twice just in terms of how they are spending or what they are spending on. So we are seeing that reflected in some of the data. But again, 8 of the 13 of the retail sectors here posting gains for the month of November. We've got the opening bell on Wall Street, and we will see whether or not some of the gains, some of the optimism from yesterday holds over into today's trading session. You can see we're not too far from the flat lines here. At the open, you have the Dow and the S&P just above here. You have the S&P up about 0.4%, well above 4,700, and taking a look as the Nasdaq opens as well. We are seeing about 0.5 percentage point move here to the upside. The Dow up about 86 points, adding to gains here at the open. Again, taking a look at the sector action yesterday, we did see outperformance here in all 11 of the S&P sectors did close to the upside. Consumer staples, communication services, consumer discretionary among those outperformers there. And it looks like at least the gains are holding here at the open with the Dow up just around 100 points. Well, the street is betting on cuts in the first half of the year, and so far, the Fed is showing that it may actually happen. Investors pricing in 6 quarter-point rate cuts in 2024 by the Fed here. Now, JP Morgan now seeing the first cut in June, pulling its forecast earlier than what it had initially expected in July. What more can we expect from the markets in 2024 as we get closer to those potential cuts, and whether or not this optimism is warranted? Sam Stovall, he's CFRA's a chief investment strategist, joining us now. And Sam, it's great to see you here. So let's talk about this optimism that we are seeing, the massive rally that we got on the back of the press conference from Jay Powell last week. Was that a bit of, I guess, was that reaction warranted, do you think?
Well, I think it was warranted because Wall Street had been guessing that the Fed was finished raising rates and then guessing that they would start to cut rates in 2024. Usually most estimates were for the second quarter, but now pushed into the first quarter. So when Fed Chair Powell actually sort of admitted that they're done raising rates, that we are most likely to be in a soft landing scenario, and that the Fed is discussing as many as 3 rate cuts in 2024, I think basically it took the lid off of the market's concerns and allowed it to shoot higher.
Okay, and so where then are the best places to be in the market if we do see 3 or more rate cuts in 2024?
Well, between the last rate hike and the first rate cut, the S&P has gained about 14% with all sectors, all styles, and almost all sub-industries in positive territory. And not surprisingly, financials and real estate have been on the top because those are the ones that had been pressured the most because of the higher rates, et cetera. So many of those diversified banks, regional banks that had been pressured because of the sell-off back in March, as well as just overall concerns of a potential recession that, at least for the near term, has been lifted.
So what are some of your top investment themes as we head into the new year? Obviously, the Fed being the massive driver of the markets here as we count down the final weeks of the year. Looking ahead to 2024, what do you have? What's top of mind?
Well, obviously, the Fed is the first one. Also, we are in the second year of this bull market. And since World War II, second-year bulls have added 12.5% to the stock market's advance. So that is fairly encouraging. Also, we're taking a look at the presidential election year that's coming up. So first-term presidencies since World War II, their election year returns have been 15.5% on a total return basis with 0 declines. So not a guarantee, but certainly a very encouraging statistic that this market certainly has further to run.
If we do see a shift in the balance of power towards the end of the year, how would the markets and when would they begin to perhaps price that in?
Well, interestingly enough, the full year is still positive whether the incumbent has been reelected or replaced. Certainly, an unknown quantity adds a bit of uncertainty into the marketplace. So we traditionally would see a bit of a softening of the market's advance after the election day has occurred. But in general, investors are still optimistic for the full year.
Sam, one of the strong points that maybe some of those who are a little bit more skeptic about the market's momentum heading into the new year has been the narrow breadth that we have seen in the market this year, specifically Magnificent Seven. We've been talking about it now for months, dominating much of that action. Do you still see more upside for many of these mega cap tech names?
Well, interesting. You've got a couple of questions wrapped into that one. First off, we have been seeing a pretty significant broadening of the market. Now we're looking at nearly 90% of the 153 sub-industries in the S&P 1500 that are above their 50-day moving average, and about 2/3 are above both their 50 and their 200-day moving average. I basically like to tell investors that following an up year, you want to stick with your winners. Let your winners ride, which is in reverse of last year when we were down. You tend to want to go from first to worst, meaning buy those groups that were beaten up the most. So consumer discretionary, communication services, technology, which were basically the Magnificent Seven, are likely to outperform the market in the year ahead. But if you want to be a little more cautious, then look toward the second tier of those companies within those sectors and sub-industries that did the best.
You got some people out there, Sam, that just want to throw caution to the wind, though, and they want to see where within other regions, other pockets of the world, they could see some outperformance next year. And we've heard emerging markets brought up a few times on this show. Just wondering from your perspective, if there are investors who are looking at any international opportunities, given some of the themes that you believe will continue to prevail, where they are right now.
Well, good question, because a lot of investors are very parochial by nature. And if they are going to look to go beyond the S&P 500, certainly you have an awful lot of attractiveness in relative PE ratios for mid and small cap stocks, each of which is down more than 30% or at a 30% discount to the average to the S&P 500. But developed international is at about a 20% discount to the S&P 500's PE over the last 20 years. Emerging markets have actually held up relatively well, but I think that because the international arena has underperformed the domestic arena for many, many years, reversion to the mean could kick in. Also, if DXY, the US dollar, is showing some weakness because of the likelihood that the Fed is done raising rates, then I think that overseas investments do actually offer an awful lot of appeal to investors today.
Sam, always great to get your insights and analysis on whatever is playing out in front of us on any given day. Sam Stovall, CFRA Chief Investment Strategist. Thanks so much.
My pleasure.
Let's take a look at some of the trending tickers here this morning. Shares of Live Nation, we've been tracking them jumping, as Destiny's Child would say. They once were on those stages. Beyonce still out there. Anyway, Morgan Stanley upgraded the events promoter and venue operator to overweight from equal weight. Morgan Stanley is slapping a $110 price target on shares of LYV, up from $100. Now, the analyst behind the call believes the fundamentals behind music and live events are some of the healthiest the entertainment sector has seen as we head into the new year. I mean, this comes off a very strong experiences economy that we've seen over the course of 2023.
Yeah, rather very confident just in terms of some of that momentum, confident in the future growth that we could see here from Live Nation. You're looking at a stock that's risen about 8% in the last week alone. So we are seeing some of this momentum to the upside in recent weeks. It has been a pretty volatile several months here for the company. We know that they have been facing tons of pressure, especially from lawmakers, just in terms of ticket pricing, what exactly played out for the pricing when it comes to Taylor Swift and Bruce Springsteen concert. Recently, just a few weeks ago, there was a Senate subcommittee that did issue a subpoena here for Live Nation and Ticketmaster for records of the company's ticket pricing and fees. The list goes on, but at least for right now, Morgan Stanley looking back, or looking past that, I should say, upgrading the stock to overweight from equal weight, saying that they have increased confidence in future growth of live events. They also just have increased conviction in that durable long-term play here for the company going forward. $110 price target. That's up from $100 a share.
Yeah, got another Taylor Swift call out in the analyst note. What's new?
There's been a heck of a lot this year.
Yeah.
I wonder how many. We gotta try to.
We'll chart that.
Them up at some. Yeah, we'll chart that. We chart everything. Leave it to Jared Blookery. All right, let's take a look at another mover here this morning. Adobe is feeling some pressure after the company reported its fiscal fourth quarter results on Wednesday. The software company's adjusted earnings and revenue did beat the street's expectations, but weaker than expected full year forecast for 2024 is one of the big drivers and one of the main reasons that we're looking at losses here for the company. The maker of Photoshop also noting that it could be hit in the future with major costs over a FTC investigation into its cancellation policy for software subscriptions. That was another big headline in these results that we got after the bell. It is important to point out, and I was going through a number of analysts' notes here this morning, the reaction that we're getting to these results. Adobe does tend to be a bit conservative in its guide. So yes, that is a big reason why we're seeing a 7% drop here at the open. But a number of analysts, including Brent Thill, including Brent Bracelin here from Piper Sandler, talking about that lukewarm outlook, but still highlighting some reasons to be optimistic about this name going forward. Some of that bullish case surrounding generative AI and some of the tailwinds that could provide here to the upside.
Yeah, I mean, you just wonder at this point how much more generative AI could be cited before the analysts are already honestly pricing it in to say, okay, here are the actual solutions, the services that this company offers where generative AI can provide the type of delta that the company is actually talking about here. And so you look at those business segments and continue to think about what the margin is that's coming in off of it. I mean, digital media segment revenue most recently in this last quarter, $14.22 billion. By the way, this was, as they noted, a record Q4. And so if they're already coming off of a record Q4, there is somewhat of a Goldilocks type of report that they would have had to deliver, both in what actually took place during the quarter as well as the guide here. And so this is the type of activity that you can see if a company doesn't hit it absolutely out of the park, clear the bases with an earnings report plus the guidance, and have the overhang of that show me story in AI, as well as some of perhaps their own kind of sandbagging, if you will, that can kind of become baked in, I guess, to some of the expectations as analysts who you mentioned have talked about as well in their guide.
Yeah, certainly. And we're seeing that play out. We have seen that play out over the last several quarters, right? Just meeting the street's expectations isn't enough. Beating the street's expectations in many instances also isn't enough. It's all about that guidance. That has really been the driving factor in recent quarters. And once again, we're seeing that play out as we count down to the end of the year.
Spot on. All right, let's talk about what's on the feets out there. Foot Locker seeing some gains this morning. The stock is up after Piper Sandler raised its rating on the footwear retailer to overweight from neutral. The analyst behind that call believes the footwear retailer will expand its margin opportunity in 2024. Piper Sandler also sees a favorable mix of full price sales in the new year on recovering inventory levels here. They have also, in their conclusion, said that they noticed a shift in investor interest to start looking at turnaround stories. So Foot Locker, potentially one of those turnaround stories, contemplating a rotation from winners in consumers such as, they note, Walmart, TJX, Lululemon, and Deckers Outdoor as well.
Yeah, this is an interesting note to me because Foot Locker is a company that needs some of this optimism coming from the street. Many of analysts have been extremely critical just in terms of those higher inventory levels, promotional activity, everything that has been playing out at the retailer over the last several months. We just got results recently from the name. They were talking about the fact that promotional activity is likely going to be high in the current quarter because of holiday sales. They need to do everything they can to move some of that inventory out. But this analyst here from Piper Sandler, looking past all of that, expecting to see some improvement, cleaner inventory levels. It was interesting to me what you just called out there, just in terms of the fact that she is noticing a bit more investor interest to begin looking at some of these turnaround stories. Yeah. That was, though, followed by the fact that she was saying that she hasn't yet seen some strong appetite for unprofitable models, high levels of debt. There is couching it just a bit, but basically saying that if Foot Locker is able to prove that it is making progress on its turnaround story, this could be a name, given the fact that it's been under a tremendous amount of pressure, could be a name that's well positioned here for the longer run.
Yeah, a few things have to go right for this to take place. Number one, the closure of some of the Champs stores. Yeah. Foot Locker has a bevy of brands underneath of it. It has Foot Locker. It's got, of course, stores within the stores of House of Hoops, and Foot Locker has done really well with the partnership with the NBA even this season as well. But you think about some of those sub-brands and where those store closures, the footprints that aren't necessarily operating up to standard or up to where the profits should kind of carry on a store-by-store basis. They were expecting to close 85 in 2023 of the Champs stores, about 73 in the fourth quarter, and the rest pushed into 2024. So ultimately, store closures are also looking at an element of needing to make sure that you're retaining the basketball kind of customer that's coming into the store in some of those partnerships. And that means really leaning into more of the rebuild in the Nike relationship. For Nike, they have been excellent at making sure that they're executing on more of that direct-to-consumer strategy. And I think now kind of opening up the opportunity for even more of those retailers who they had historical relationships with on the wholesale side, but then kind of reset much of that in order to make sure that they could get a lot of the customer data and then decide, all right, where do we need to kind of allocate a certain amount, what percentage of inventory needs to still go into a Foot Locker, what percentage needs to still go into a Macy's, and what do those wholesale buying habits look like? I think that's one key relationship they got to get right too.
Yeah, but again, the most recent results that they did report, it was a very strong report. The guidance was better than expected. They are making some headway. They did say that they saw strong traffic over Black Friday weekend, holiday shopping weekend. You do your channel checks, what, twice, 3 times a week? What do you see?
Yeah, I've gone in there twice already this week. Okay. Yeah, I was looking for the Jordan Gratitude, the Jordan 11 Gratitude that.
Do they have it?
I mean, well, I ordered it on sneakers anyway, so it didn't really matter. But I was seeing if they had it in store. Well, that's actually what I'll do sometimes is I'll compare to see if something dropped on sneakers one day and it says it's sold out on sneakers, but then I walk in a store and I see it. Not only am I upset, but I'm also saying to myself, okay, now they've got inventory that clearly is not sold out at the end of the day. So I don't know. That's why I do some of these store checks from time to time.
Well, and you must, and you're trying to get the best deal too.
I'm trying to
just get your hands on the product at the end of the day.
Right.
All right, well, we've got to leave that there, but keep right here on Yahoo Finance. We've got all your market action ahead. Stay tuned.
There's too much time on my hands.
New year, new outlook. As 2023 draws to a close, brace yourself for a riveting financial look ahead to 2024. Here's what we'll be watching. The soft landing debate. Are we heading for a recession? The AI hype cycle. Is it still real? And the 2024 presidential race. President Biden and former President Trump seemingly set to square off yet again. We'll break down how this election could impact your long-term investments, so get ready to uncover the insights, predictions, and financial secrets that will set the stage for what's expected to be a prosperous new year. Join us for our year-end finale that will leave you both informed and inspired.
Well, chip stocks hitting all-time highs this year, spurred by growth of generative AI. The sector, though, loaded with competition. Intel, one of the big players, looking to make headway. At its AI Everywhere event today, investors are expecting that Intel will attempt to reinforce its position. We are expecting to hear announcements about latest processors designed to integrate with AI. We want to bring in More Insight Strategy CEO and Chief Analyst Patrick Moorhead to discuss more on this, what to expect, where we are in these chip wars, and exactly who is the leader. But Patrick, let's start with Intel, because I know you had the chance to speak with Pat Gelsinger before the event today. I'm curious, what did you learn, and what does that tell you about Intel's strategy here looking ahead to 2024?
Yeah, so I had a good conversation with Pat Gelsinger, and essentially he reiterated his AI everywhere strategy. And that's putting AI at the PC, putting it in the data center, and everything in between. And right now, Intel's not getting any credit for what it's doing in AI. It seems like companies like NVIDIA, AMD, Marvell, and Broadcom are getting all the attention. And today, Intel is announcing its new PC notebook processor, codenamed Meteor Lake, and it's also updating, adding a new processor to its server roadmap, Xeon. But he didn't talk about any new accelerators, which who knows? Maybe we'll see that at the event.
Yeah, I mean, ultimately, when you kind of look through these announcements and what's set to be discussed and communicated to the street at this event, what would you have to hear to give this an A grade, perhaps, for Intel, and how would you rank them kind of coming out of this event to ultimately say, okay, they've got an upper hand and know what they're doing with generative AI, and it's actually going to trickle through to margins at the end of the day?
So I'd like to see customer reception. I'd like to see customer after customer echoing exactly the claims that Intel is making. And the challenge is that AI PCs, for example, the competition from AMD and a new company coming in there, Qualcomm, is ferocious. And on the data center side, CPUs for heavy-duty AI processing are being replaced by GPUs and other types of technology. So I'd like to see some progress or some technology show up and then customers affirm that says that they're going to start using more Intel silicon for AI in the data center. That would move the needle for me.
Patrick, what do you think when we take a step back and take a look at some of the trends that are playing out in the broader chip space? We have a number of these chip players at or right near their all-time highs. A lot of this momentum as we head into the end of the year. Looking ahead, though, to 2024, what do you think growth is going to look like? And if you had to pick a couple of the top ones that are positioned here heading into 2024, who would that be?
Yeah, so I think that the AI training market will continue to rock. And 18 months, 24 months, and then we're going to see it move to what's called inference, and that's the processing of that. And that can happen in PCs. It can happen in a McDonald's drive-through. That's going to be the next build out for the next 3 years. That could be even bigger. So you're going to see companies like Qualcomm get a lift from this, and they're not getting really any credit whatsoever. Intel plays in this market, as I said before, and I think AMD is going to get an even bigger lift as well. And I also think that you might see some of the more integrated plays that's in the Internet of Things get a bigger boost in, let's say, 2025. The memory market and the storage market has been in a slump for a long time. And whether it's Micron, whether it's Samsung, pricing has started to stabilize. But if you look at most of the declines this year, they were primarily based on the memory and storage glut we had and the pricing actions that those companies had to take. So very closely, I'd probably put Micron in that category as well. But the predominant amount of memory and storage that they ship is not related to AI, but we're seeing more and more of a pricing trough. And I think we could see a big bounce back from that company.
With regard to generative AI, there have been a few different tiers for us to think about how companies are going to be impacted and how they're going to communicate or perhaps engage with customers. One of them is on the B2C side, where it's as simple as, hey, if you pay us $7 a month, you can get access to ChatGPT, right? On the other side, though, you've got some more serious B2B margin generating opportunities, whether that's business to business on the data center side, whether that's business to business on the Copilot side. All these things considered, what determines the pricing power that companies have when they take these solutions to market?
So companies are testing that right now, right? We saw with Microsoft 365, an extra $30 per seat per month. Now, if you can increase productivity by 45%, by 25%, that is a really good deal. And then you have companies like Zoom, who's giving it away for quote unquote free, maybe pricing to be determined later, who are really going for market share and making sure that more people buy what they have. But more than not, and I think this is a good sign, companies are charging more. Salesforce is charging more, Microsoft is charging more, Google is charging more. And that sends a good message. And we will see how that tests once every one of these services go generative AI. The picks and shovels, right? The B2B, right? From the silicon to the infrastructure as a service with AWS, Google Cloud, and Azure. I'm expecting to see those bounces in 2024. Right now, they're taking on a tremendous amount of cost. My estimates put a 10x price increase to train a generative AI LLM versus, let's say, machine learning. The good news is that people will ride the cost curves down, and companies are finding more efficient ways to work on smaller models. So while I do expect that it could cost about $100 million to train one of these giant models at first. Companies are learning you can pull one of those things off the shelf, like Meta's Llama 2 and upcoming Llama 3, and be able to not take a charge on that, and then add value to, let's say, if you're a doctor or a lawyer and you need smart answers. So the economics are coming together here. The great part is that it's real, right? It's
Right.
adding real value to consumers and real value to businesses that so far they're willing to pay for, just not a lot of them.
Just lastly, while we've got you here, I mean, 2023, hype phase and beginning of the delivery cycle, and then additionally 2024, delivery cycle plus a little bit more of the kind of maintenance and ongoing, perhaps, engagement cycle for
Right.
generative AI. I mean, by 2024, I want to be able to feel the inferential generative AI in the fries that I get from McDonald's, as you mentioned earlier on. At the end of the day, have we seen the most kind of the gains, the share price gains behind us in 2023, or is there more to come and building upon that in 2024?
So I think there's more to come. I think it just depends on the ticker. Intel's getting zero credit for AI, and they're gonna very well be a big part of this. NVIDIA, AMD, Marvell, and Broadcom have seen small pops, but we haven't seen anything. And quite frankly, Amazon Web Services, Google Cloud haven't really seen any. In fact, we saw a sell-off with Google when they came out with their early generative AI demonstration, and then another sell-off after that. But Google is very much going to be a player in generative AI. They're just not getting any credit for it right now. So I think those big names, the Salesforces of the world, right? We've seen a bounce back on them, but I don't think it's necessarily AI. I think it's necessarily the hygiene that they've had from expense management. But we will see a lift in 2024, maybe not as pronounced as in NVIDIA, but as it goes downstream and there are more participants in the value chain, we're going to see it. And I've been in the market almost 35 years. I've never seen anything close to this. The only thing close to this was the run-up of internet technologies in Web 1.0 with the Ciscos of the world. But this boom makes that boom look small.
All right, more Insight Strategy CEO, Chief Analyst Patrick Moorhead. Great to have you here with us today. And tune in for our afternoon show today. Our executive editor, Brian Sozzi, going to be sitting down with Intel CEO Pat Gelsinger to get his thoughts on the company, the chip space, and new innovations to come. Well, today's vibe on the streets, the battle of the bond kings. Double Line Capital's Jeffrey Gundlach is expecting a pullback in treasuries, telling CNBC, I guess, that we will see the 10-year Treasury yield in the low threes sometime next year. But PIMCO co-founder Bill Gross is singing a different tune, posting on X that the 10-year yield falling to 3% in 2024 is farcical. Wow. All right, fighting words there over Twitter.
Yeah, but when you take a look at this, I mean, it's no huge surprise that we are seeing some sort of disagreement here. Gundlach has been very vocal. He spoke at Yahoo Finance Investor Conference. They're sitting down with Brian Sozzi earlier this year, just last month, talking about the fact that he does anticipate a bumpy road ahead, talking about the fact that we do have this risk of recession. So we get this dovish comments here from the Fed. And he also went on to say that the economy is going to undershoot to the downside, and that is going to create a response. He thinks that the Fed is going to have a lot of money printing here to offset some of that. And of course, this is on the heels of the dovish signals from the Fed yesterday that did send yields lower. Bill Gross, though, a little bit more apprehensive, saying that where yields are today, right around that 4% level, he thinks is where they should be, at least for now.
Yeah, he went on to say bond strategy should continue to focus on return to positive yield curve, and gave some of his own positions. And he had said yesterday that it's a great day for that curve, as you were mentioning a moment ago. I don't like the Eagles versus 49ers reference that he made. Bill, shouting you out on that, unfortunately. Regional banks and mortgage REITs up 4 to 5% today, kicking butt like the 49ers versus the Eagles.
Too soon.
Too soon. Yeah.
Too soon for
That was a
these
cheap
two
shot.
Eagles fans. But we'll see. Maybe we'll get redemption.
We will.
All right, we'll keep right here on Yahoo Finance. We've got all your market action ahead. Stay tuned. We'll be right back.
Welcome back, everyone. I'm Brad Smith alongside Shauna Smith here live in New York City from Yahoo Finance Studios. We're about 30 minutes into the trading day. Let's take a look at how things are shaping up. The U.S. market's moving higher over a stronger than expected retail sales report. November retail sales posted surprise growth, signaling the U.S. consumer remains in better position than feared. And the S&P is up as investors continue to celebrate a dovish shift by the Federal Reserve.
Taking a look at some of those individual mover shares, a fintech firm, Affirm, is pushing higher along with its rival Upstart. Now, this comes after the Fed decided to hold rates steady in its final rate decision of 2023. You're looking at Upstart shares up just about 8%.
And a nice pop from Six Flags this morning. The amusement park operator was upgraded at Morgan Stanley to overweight from equal weight. The analyst behind that call sees Six Flags revenue growth accelerating in 2024 and believes a potential merger between Six Flags, Cedar Fair, and that deal making would serve as a potential catalyst, a positive catalyst for the stock.
We are watching airline stocks today. Goldman making its top picks for 2024, saying that investors should stand by Delta and United. Those are their top plays in the airline space. The analyst behind that call is citing accelerated growth in Delta's high margin business and potential in United's premium travel exposure. We're seeing gains in both of those names here just about 30 minutes into the trading day. But Brad, I know you closely follow this sector, obviously, but when you take a look at some of the dynamics that are at play, it hasn't exactly been an equal playing field, at least this year, in terms of the performance. Delta has really gained some momentum and outperformer there, especially when you compare it to the gains that we saw this year from United. But Goldman bringing up some interesting points here just in terms of why they like United and Delta and why it makes sense given the current environment.
But yeah, it was one of Goldman's top airline picks last year as well, looking towards a traveler that was looking to go more international. They also expected more of the rebound in 2023 for the corporate travel. Some of that corporate travel also expected to return continuously continuously in 2024 here, and it'll be interesting to see, especially among some of the restructuring of costs, or at least cost management measures in that cost discipline conversation that companies are having, where T&E perhaps takes some of the wind out of the sails there. However, from what we've seen over the course of this year, there has been that rebound in corporate travel, events, people getting back out there, deal making taking place. And so ultimately, that is one of the things that they pointed to at the start of 2023. Seems like that still lingers here going into 2024. They also mentioned specifically that growth will accelerate in their less cyclical, high margin business. Corporate is a high margin business. I mean, prior to the pandemic, about 75% of profits that airlines were seeing were largely coming through from corporate travelers there. On the other hand, they said United here, they are less exposed to the Pacific market, seeing potential in the exposure to premium travel there, as you were mentioning a moment ago, and really repositioning the entire flight experience, but it's going to come at cost. And at what cost is the customer willing to take on for those flight experiences as well, in all of the consumer data that we've been continuing to track as well here.
Yeah, certainly two names there to keep on your radar as we enter 2024. All right, well, let's connect the dots. The Federal Reserve expecting to begin cutting interest rates next year. The Fed releasing its updated forecast and its summary of economic projections, including its dot plot, which maps out policymakers' expectations for where interest rates could be headed in the future. Officials signaling in those projections that the Fed's inflation battle may not require another rate hike in the new year, penciling in 3 rate cuts, and they now see inflation falling to 2.4% in 2024. For more on what we heard yesterday and what that means for policy going forward, we want to bring in Nick Timmerose. He is the Wall Street Journal's chief economics correspondent. Nick, it's great to see you. Thanks so much for taking the time.
Thanks for having me.
So let's talk about what we heard yesterday, because it seems that the updated economic projections are confirming what markets have come to believe: more rate hikes ahead, or rate cuts, I should say, in 2024. Do you think, though, it might be a little bit too soon to declare victory, given the fact that inflation still remains a ways away from the Fed's 2% target?
Well, it depends on what benchmark you're using to measure inflation. So if you use 12-month rates, yes, inflation is not at 2% at a 12-month rate. If you take what we got this week out of the CPI and the PPI from the Labor Department, and you feed that through into what's going to be in the Fed's preferred gauge, which comes out later this month from the Commerce Department, that's the PCE price index, you're looking at a 6-month annualized core inflation rate of 2%. So over the last 6 months, the Fed is essentially at their target. And I think that's what reflects the pivot that you saw yesterday from Fed Chair Jay Powell. If you're hitting your target over the last 6 months, you're not going to declare victory, because, of course, things could move back up. But you may not need to be at 5 3/8% much longer on the Fed funds rate if you're actually going to be back at 2 or even 2.5% core inflation.
And so if we were to see next year, because the expectation is that the Fed is going to continue in its inflation combating, but at the end of the day, how close will we actually get to their target, and will a 2 handle satisfy?
Well, I mean, they're at a 2 handle now, again, if you use the 6-month rate. And I think that explains why we saw a pivot yesterday. If you just go back 2 weeks ago, Jay Powell spoke in Atlanta, and he said it was premature to talk about lower rates, to speculate around when policy might be eased. Yesterday, he was asked about it, and he said, we did have a discussion around that. It sounded like a preliminary discussion, but it didn't sound like somebody who was saying it was too soon to think about when they would ease. So, it doesn't mean that they're going to cut interest rates in January, but it does seem like they could be moving ahead the discussions around when to cut rates after that, if inflation continues to come down. And that, tracks almost exactly with what Fed Governor Chris Waller said a couple of weeks ago. I asked him a question about whether the Fed would cut rates, even if the economy was doing okay, if core inflation was back to 2.5%. And he said, yeah, if we see 3, 4, 5 months of inflation behaving like this, then a Taylor rule would tell you, a standard monetary policy rule would tell you that you don't need to be at 5 3/8 on the Fed funds rate.
Nick, I'm curious just to get your thoughts on all of this, because leading up to this announcement, and not so much the decision, but the press conference that Powell held, I think some of his commentary, the U-turn that he seemed to signal, caught the markets by surprise. Did it catch you a little bit by surprise? And then in terms of some of the hawkish members of the Fed, do you think we're going to see them maybe back away from some of their aggressive rhetoric here going forward?
Well, we already have, right, with one more hawkish governor, which was Chris Waller. So, if you were paying attention to what Waller said, then what Powell said yesterday wasn't much of a surprise. I think, there was a disconnect in a couple of places. The first is in the policy statement, because really the dots are not a committee. They don't come to some agreement on the dots, but they do come to an agreement on what's in the statement. So what's in the statement? Well, the statement retained a very weak tightening bias, but it retained a tightening bias nevertheless. And so you have a statement that sort of seems incongruous with what the chair was saying in the press conference. The statement's saying we haven't decided, whether we've done enough. We think we've done enough, but we're not sure. We're not going to say that we're done raising rates. And Chair Powell sort of, kind of quietly made the same point in the opening of his press conference. But as the kind of live fire went on during the press conference, he was saying things, risk management, where, we don't want to stay too high for too long. We realize that's a risk. That isn't something that you heard him saying before when inflation was quite high, and he was saying we just can't fail on getting inflation down. So you see the 6 months progress. They're feeling better. He said in a response to my question, we're seeing progress. We just need to see more. And one final point I'd make is that in the past few times that Powell has spoken, he has actually referenced the 6-month annualized core inflation rate, because the last 6 months have been so much better than the previous 6 months. And I thought it was interesting that he did not do that yesterday. He cited the 12-month inflation rate. The 6-month rate is at 2%. And I think it would have been a little, it might have sounded funny to say, well, we're not sure if we're done hiking, but we're at our target on a 6-month basis. So he didn't say it in the spot in the comments where he normally does.
Powell wouldn't declare victory for himself, but how do you see this? Do you kind of see this as a win for Fed Chair Powell and the FOMC?
What's not to like about where they find themselves right now? Inflation has come down a lot in the last 6 months. It was running around 4.5%. If you look at core in the first half of the year, it's running, in the low twos, maybe a little bit higher in the CPI profile over the last 6 months. So you like that. The banking stresses, obviously there's still concerns in the banking system, but nothing like what we saw in March, April, May. So you've got to like that. The economy slowing down from the torrid pace of growth in the third quarter, but you don't see recession in the claims data, in the retail sales data. So what's not to like about this? I mean, the conversation they're having about can we cut interest rates even if the economy is not weakening, that is a first-class problem for the Fed to have, and we should hope that it continues. It would be great for the economy if they're in a position to have that conversation and the economy doesn't go into a recession in the first half of next year.
Nick Timmeros, always great to get your insight here, especially on the day after a big day like yesterday. We appreciate you taking the time. Wall Street Journal's chief economics correspondent. Thanks, Nick. Well, coming up, the countdown continues. We are breaking down the biggest stories of 2023. Number 4 is next. We've got the details for you when we come back. We are counting down the top 10 stories of 2023 here at Yahoo Finance. And coming in at number 4 is union strikes.
We're not asking to be millionaires. We're not asking to join the billionaire class. We're asking for our fair share of the fruits of our labor.
Well, the prolonged actors and writers strike continues to shake up the box office.
It was affecting restaurants and catering companies. It was affecting trucking companies. It was affecting welders. It was affecting construction people. It was affecting dry cleaners.
Members of the United Auto Workers overwhelmingly voted to authorize possible strikes against the nation's 3 major auto manufacturers.
You're looking at the UAW president right now, essentially wearing black and white camo. This sounds like a UAW president that is in his own type of wartime mode.
From the writers and actors in Hollywood to the factory workers in Detroit, union members across the country taking to the picket lines to advocate for higher pay and better benefits. Here to break it all down, the impact and the outcomes of these strikes are our very own Alexandra Canal and Pras Subramanian, the two perfect people to talk about the union strikes and what we have seen play out over the last 12 months. But Ali, let me start with you. When it comes to the Hollywood strikes that started with the Writers Guild of America back in May, obviously lasted for longer than maybe some had initially anticipated. What was the outcome and what did we see?
Well, this was a historic strike considering we saw the actors join writers on the picket lines in July. And although these are 2 different guilds with 2 different wants, the thread line was similar in terms of what they were fighting for. Better protection surrounding the role of artificial intelligence, better pay, streaming residuals as more TV shows and movies go from cable to those streaming platforms. And these strikes, they come after the contracts have expired, and every 3 years you get a new contract. What was 3 years ago? It was 2020. It was the pandemic. Hollywood was just trying to keep the lights on. So there was this expectation that the guilds were going to really come into 2023 ready to fight with these studios. In terms of what they were able to get, the writers' strike lasted 118 days. They were able to secure increased regulations surrounding AI, minimum staffing requirements. This was a big one. They wanted a certain number of writers in the room, especially as streaming has allowed for more content. And they also saw viewership-based streaming bonuses and more data transparency, which I think is something that we're going to see across the industry. And then for the actors, their contract was valued at over $1 billion, also included above pattern minimum wage increases for AI. Members will receive, quote, informed consent and fair compensation for the creation and use of digital replicas of members. And then for the first time, there will be a roughly $40 million per year streaming residual bonus. So these were pretty sizable wins here when you think about these guilds and what they were ultimately fighting for here.
And Pras, I mean, we also tracked this UAW strike. Sean Fain essentially became a household name. I expected him to be a TikTok influencer after a while.
There were rap videos.
There were rap videos kicking off these press conferences. It wasn't even a press conferences. It was really just a briefing of what was going on. Did we encapsulate it well enough?
So Brad, the thing was, 6 months ago, no one knew who he was. He was the X factor, in my opinion. People were saying this guy came out of nowhere. He was a longtime member, but he was never in leadership, really. He won by a razor slim margin. And all of a sudden, I heard rumblings in the summer. Car companies or execs were kind of worried. They didn't know what to expect, and they had every right to be afraid because what we saw was these unprecedented strategy of stand-up strikes starting in mid-September, right? Caught everyone off guard. Instead of just striking one auto plant or one automaker and then making a pattern agreement and going to other guys, they struck all 3. Mm-hmm. So there was a little bit of shock there. I think one of the biggest things, the timeline here, is when Biden walked the line about 2 weeks into the strike. That was a huge turning point. A few weeks later, we had Ford kind of put out an actual real offer that the union entertained. Shortly thereafter, you had a preliminary agreement, and then you had all the big 3 getting their workers to agree to the deal. But there was a hiccup with GM, of course, because of the fact that there was older workers that weren't necessarily happy with that deal. But and then at the end of the day, it all went through, and now we have a deal, and workers are back.
Pras, what do you think, though, this tells us about some of this momentum carrying over, right? Because this could almost just be the start when we take a look at the auto sector here. But the fact that they were so successful, the impact that it's going to have on these companies and what it means for maybe some of those other automakers that have yet to be or have not yet been the target of the unions.
I mean, within a few weeks of that deal being ratified by the membership, you had Toyota, Honda, I believe Hyundai, all giving raises to their U.S. workers who are all non-union. I spoke to labor strategists about that, and that's called the union substitution effect, where they're like, hey, we'll pay you enough to just not unionize, just take it. But they wouldn't have necessarily gotten those hikes if not for what happened this summer with the UAW.
So what economic impact did these strikes have on their industries as well as the broader economy here?
Well, we found out from the October jobs report that all in all this year, the UAW strikes, the Hollywood strikes, led to a loss of 75,000 jobs. Now, we saw that tick up again in the November jobs report. And then if you think about specifically to Hollywood, the cost to the LA economy, that estimate has been around $5 billion, primarily due to lost wages. And then you also had studios reshuffling their release schedules for the box office. The Dune sequel, that was a big movie that was supposed to debut in November, pushed into 2024. Luckily, with Barbenheimer and some of the other momentum with the Taylor Swift movie we got this summer, I think that helped lift those box office dollars a little bit. But it certainly wasn't an easy thing. Hollywood was completely shut down. You heard from all these studio executives how it was going to hit their bottom line the longer it continued. On a positive, you saw free cash flow go up. So I think coming next year, you're going to see those comps be pretty tough because no one was spending money on creating new shows. Now I think you're going to slowly see production ramp back up again.
Absolutely. Alexandra Knau, Pro-Subramanian, thanks so much for tracking all of these strikes as you've written about them at length over the course of the year and then helping encapsulate it here on the desk. We appreciate it.
Thank you.
Thank you.
Well, it wasn't just Hollywood and Detroit who were on strike this year. We saw UPS employees, airline staff, healthcare workers, all at the negotiating table. And while some of those deals are shored up, there are lingering disputes on the table as well as new ones on the horizon for 2024. For one, Starbucks, in a reversal, says it will restart bargaining with its union and reach an agreement next year. And then we have the UAW perhaps turning its sights to Tesla. That's not all. Contracts are up in 2024 for the U.S. postal workers, Hollywood crew members, and then East Coast dock workers. So still a lot of collective bargaining, labor negotiations that could perspire in 2024.
Yeah, and I think a lot of this also ties back to the administration, what we've seen from the White House. Like Praj just mentioned, the fact that when President Biden came and made a few comments there kind of changed the tide to really gain some of that momentum here. For the union workers, the Biden administration has been referred to as one of the friendliest presidents to the union here in quite some time. So we are seeing this momentum pick up. It has certainly been one of the biggest stories within business news over the last year, has touched a number of industries when you take into account the airlines, retail, consumer discretionary, autos, entertainment. And you got to think that some of this momentum is going to carry over into 2024, especially as we look ahead to the election year, what exactly that means for some of these types of movements. So a number of companies are still going to be dealing with what many of these workers say they have the upper hand with now when it comes to pay, when it comes to better benefits, and they're more confident in getting those demands because of how exactly the auto workers strike played out and the strike that we saw at Hollywood.
And it's a question, to what extent does some of that negotiation also lead to or result in a pass-through of some of those costs to consumers, which is a larger thing to continue to track going forward. Everyone, we've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
New year, new outlook. As 2023 draws to a close, brace yourself for a riveting financial look ahead to 2024. Here's what we'll be watching. The soft landing debate. Are we heading for a recession? The AI hype cycle. Is it still real? And the 2024 presidential race. President Biden and former President Trump seemingly set to square off yet again. We'll break down how this election could impact your long-term investments, so get ready to uncover the insights, predictions, and financial secrets that will set the stage for what's expected to be a prosperous new year. Join us for our year-end finale that will leave you both informed and inspired.
As we near the end of 2023, employers are having to make difficult decisions to cut jobs as they grapple with uncertain macro pressures. In December alone, companies like Spotify, Hasbro, Etsy, and Twilio all announced reductions to headcount. What is the signal for the labor market in 2024? Daniel Zhao, who is the Glassdoor senior economist, joins us now. Daniel, always a pleasure to get some of your insights. I wish it was on better occasion, but the reality right now of how this factors into the broader labor situation, what's your read through on it?
Well, we are seeing that the job market is slowing down as we head towards the soft landing. And in some cases, that has meant slower hiring, but in other cases, that has meant layoffs. So we have seen a little bit of a mini wave of layoffs as we approach the end of the year. It's not quite the same as what we saw last year, but clearly we are seeing a little bit of labor market cooling.
So Daniel, looking ahead to 2024, do you think we'll see more of a continuation of this, or will we see some of these companies that had been laying off workers or have been sitting on the sidelines, hiring freezes, begin to lift and start hiring again?
Well, I do think that as we head into 2024, we are going to see a little bit of a reversal in the sense that as we entered this year, really the theme was that everybody thought there was a recession on the horizon, right? And so as we head into 2024, I think there's a little bit more cautious optimism about the likelihood of a soft landing. And so hopefully we will see employers start to open up hiring again, especially as we get into the new year and new budgets are set and that sort of thing. I think November, December is always a tough time for hiring. It's always a little bit tough for folks trying to find a job because of how slow things get.
What is your anticipation for the hot sectors where there will be perhaps a wave of hiring in the new year and the types of roles as well?
Mm-hmm. Well, for 2023, I think one thing that really jumped out to us in the data is the industries that are really hiring are healthcare, education, and government. And I do expect that in 2024, we're going to continue to see that. I mean, just for healthcare alone, that's an industry that we expect to continue to have more demand for workers, especially as the American population ages and the demand for healthcare services increases. And one thing I'd like to call out here is that people often think about industries as pretty separate, but every industry needs, for example, like IT workers or administrative assistants. And so there are a lot of skills that are very transferable between industries for people to look for, where those jobs are that fit their skills.
Daniel, you have a great sense just of the jobs that are available, what some of these employers are offering here there at Glassdoor. What are you seeing the activity like on your platform? And when it comes to some of those benefits and perks that companies had to offer employees because the job market had been so tight over the last couple of years, is that still the case heading into the new year?
Well, I think we're getting a bit of a mixed bag here. One thing that we are expecting to see in 2024 is as the labor market cools, especially from the very hot job market that we've had in the last few years, we do think that employers are going to pull back on benefits because, while workers really hate to have their pay cut, like they hate seeing their salary or their wages go down in their paycheck, they often have a less clear sense of how much their benefits are worth. And so you might see employers start to pull back on benefits, especially some of the perks that were really popular in the late 2010s, like free lunch in the office or like ping pong tables, that sort of thing. I think that those kinds of benefits are going to get pulled back as employers try to manage costs.
It's okay. The Papa Shot that we have here is better anyway, Daniel. I've been enjoying that, quite frankly. But at the end of the day, I mean, one of the huge things that we think about in correlation with the overall compensation package is just what we heard from the Fed yesterday, and is specifically on wages. Wages still running a bit above what would be consistent with 2% inflation over a long period of time. How does this have a broader, perhaps, economic pass-through on the wage front?
Well, I think we're very close to where the Fed wants to see wages. And in fact, when you look at some of these other labor market indicators, like the quits rate, I think is a great example, you're seeing that we're pretty much back at where we were before the pandemic. And granted, the pre-pandemic labor market was a pretty hot labor market by historical standards, obviously not as hot as what we saw in 2021, 2022. But I think we are very close to a labor market that, as the Fed would say, is in balance. So I think there's a strong possibility that in 2024 we're going to be able to attain that soft landing, at least from the labor market side of the equation, right? The labor market is doing its job to get us toward the soft landing. Really, it's up to inflation now to do its part.
To what extent do you believe reskilling will be one of the most perhaps prominent thoughts among the workforce right now, Daniel?
I think there are a few ways to look at this. One is I think there are a lot of skills that are transferable. I think a lot of people underestimate how useful especially their soft skills like communication and customer service might be applicable in different industries and even different occupations. But beyond that, we know that there is a lot of disruption going on in the workplace nowadays, right? We talk about AI all the time, and I think there's potential for a lot of disruption that comes with that technology, and it's very difficult to predict exactly what skills will be important or what jobs will be affected when you have this kind of paradigm shift.
Daniel Zhao, always great to get your insight here. Thanks so much for joining us here this morning. Glassdoor's senior economist. Apple's rally doesn't seem to be slowing down anytime soon after notching another record high yesterday. The tech giant's market cap is now nearing the value of the largest stock market in Europe, France. And Citi, well, they think Apple still has more room to run. Yahoo Finance's Ines Ferre has the details on that. Hey, Ines.
Hey, Shauna. Yeah, as you mentioned, what a run Apple has had this year. Let's take a look at our Wi-Fi interactive board so you can see the action here. We're watching Apple shares about 1% higher, just slightly higher right now, or a fraction of a percent. But look, really, the year to date is what we want to take a look at, because year to date up 53%. Today, Apple shares touching all-time highs. Its market cap, as you mentioned, I'm going to pull up the market cap so you can see here at almost 1 trillion market cap. So it's had a huge run. This company is now the world's most valuable company. And what a reversal from last year, where we saw Apple at 52-week lows. Last year, we saw the stock going as low as $125 a share. Today, touching $199 a share. Yes, Apple has had 4 quarters of declining year-over-year revenue, but analysts are expecting that revenue is going to reaccelerate going into 2024 as demand for smartphones, demand for computers, laptops, that rebounds. And you've had Citi analyst Atif Malik putting out a bullish call on Apple, a bullish note saying that services is going to be a growth engine for Apple, will continue to grow in revenue in 2024. Malik has a buy rating on the stock and a $230 price target on Apple shares. Also, one other note is that Apple could also benefit from low penetration in India. So if it increases its market share in India, where in India you have a lot of people that are using the Android phones, then that is also very bullish for Apple. There's 34 buys, 15 hold, 14 sells on this stock, guys.
Ines, appreciate the breakdown, tracking all things AAPL. Thank you.
Thank you.
Everyone, we've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Brace yourselves and your portfolios for some wonky options dynamics in play today. This Friday marks a triple witching expiration, the fourth and final of the year. Stock options, index futures, and index options will all expire on the same day. Typically, such days bring unusually heavy volume and volatility. Here with a closer look, we've got our own Jared Blickery. Hey, Jared.
Hey, Brad, somebody said wonky, so that's my cue here. I'm looking at the S&P 500, $5 trillion in options expiring today. 80% of those are in the S&P 500 and related products. Now, the index options actually expire on the open, so that's in the rearview mirror. ETF options, single stock options going to expire at the end of the day, last tick of the day. And the 2023 average here for options has been not quite as big, I believe, as 2021. That was a breakout year, but 44 million option contracts per day. And we've really seen this accelerate recently, especially as the VIX has been heading down, now with a 12 handle. And I just want to show you what's been happening with the small caps. This is small cap call volume. Call options are, if you buy it, it's a bullish bet on the play here. That goes back to 2016. I mentioned 2021. That was a year of GameStop. In the middle of the year, we had a big surge in buying, but it is now dwarfed by what we have seen this year. So really just incredible volume. And what's been happening with this 20-year record in options volume, it has been suppressing volatility. We just went a month in the S&P 500 or thereabouts without a 1% day. That was broken yesterday. That was on the Fed announcement. And by the way, that was the biggest Fed reaction that we've had since July of 2022. So all kinds of strange things happening at the end of the year. Usually we don't see this kind of activity in December. Now there's only one catalyst left, in my opinion. That's the Bank of Japan meeting next week. Probably going to be a dead meeting, but probably not going to come from a lot going to come from that, but it is still a live meeting. Options traders over there and derivatives players have been pricing in the potential for a rate hike. But aside from that, I just want to concentrate on the VIX here. This is the VIX map in cyan that was available at the beginning of the year. I started calculating this and posting it about May, June, and we can see in the cyan how this has matched up with the actual performance of the VIX in the purple here. And now we're all the way down at the end of the year. You can see one final dip left. Are we going to get below 10? Difficult to conceive, but that could happen. Now, something else important happens when the VIX starts staying under 15. And this is a chart that goes back to 1986. The S&P 500 is in purple. These light blue lines here, it's shaded. That happens when the VIX is under 15. And what we notice is these tend to be prolonged secular bull markets. And so we saw that in the mid-90s. We saw that in the run-up to the global financial crisis. We saw this a couple times in the teens. And we did have one off. But I would mention this because it's possible we have another one off this way. I just want to close with one more chart here. This is the Dow. When it makes a new high after 1 year without one, just another signal that tends to be very bullish. We can see going back to the 1940s here. This has happened several times, but they're just pointing. All the arrows are pointing directly north. Bullish, guys.
All right, that's what we like to hear as we end the year. Jared Blickery, our wonky markets reporter. Thanks so much, Jared. All right, well, this morning, Moderna shares are spiking. We're looking at gains of nearly 12% in today's action. This coming after the pharma giant's experimental cancer vaccine used alongside Merck's blockbuster drug, one of Merck's blockbuster drugs, cut the risk of death or relapse of the most deadly form of skin cancer after 3 years by nearly half. Now, this is all according to mid-stage trial data released today. Yahoo Finance's Anjali Kamlani sat down with Moderna CEO Stéphane Bancel about the announcement this morning. Let's take a listen.
We are so happy for patients. You remember we were together last year with a 2-year data in terms of survival, and it was 44%. And now it's close to 50%. And so if you think about it, that was compared to the best drug available today, which is Keytruda, used as monotherapy. And so it means 1 in 2 people will be able to be risk-free of a cancer 3 years out. And the data is actually improving, 44% at 2 years, now 49% at 3 years. And we have a lot of ideas how to even improve the technology further, from new science, from manufacturing. And so I think it's a big deal for melanoma patients. We're going to work really hard to see how we can accelerate the launch in some countries, potentially as early as 25. And then, it's not only melanoma. We announced on Monday starting a phase 3 in lung, and we're going to have more phase 3 starting in 2024. So that's going to be a very big platform within Moderna.
Absolutely, and certainly validating the mRNA sort of platform, which is what I know the street has been waiting for. I want to talk about also the other vaccines you have in your pipeline. We know RSV is set to launch next year. What can you tell us about that and sort of the rest of the pipeline, including flu, which we know you had to delay a little bit?
Yeah, so we're very excited about RSV. As you know, RSV is the third respiratory virus after COVID and flu that kills people in the US every year. And so there's new vaccine that have been launched by 2 other pharma companies in the fall. It's the first time there's been RSV vaccine. But what is exciting about our product is it's going to be the most convenient product for pharmacists and for doctors, because it will be in a pre-filled syringe. The current vaccine on the market are pretty cumbersome to prepare. Every time you have a new patient who wants a vaccine, the doctor or the pharmacist have to do with one vaccine 9 steps of preparation. With your vaccine, 4 steps of preparation. With Moderna, basically pre-filled syringe, you just inject it and you're done. And so if you think about the pharmacy retail chain, the independent pharmacists and the doctors and nurses, they are so busy. As you know, there's a lack of healthcare workers, given the aging of the population. And so we think we want to be part of the solution. And so we think we'll have a big launch. I'm actually very engaged with the team on preparing the launch. And I'm very excited for that new product. That will be the second product, which also will mean and will be the proof that we have a platform. We've been saying for many years, even before COVID, that mRNA is enabling us to build a platform. The pharma and biotech industry have built what I call analog drugs, where every drug is different, where you have to reinvent the drug in the labs, clinical studies, and manufacturing. But with mRNA, we're able to go very fast, and we're able to get very high efficacy. So that's going to be a big game changer for medicine and patients.
Definitely. But we also know that you're looking at realistically what the market is going to be. To your point, there are already 2 others on the market, and you've guided that by next year, you anticipate that the COVID vaccine and the RSV vaccine, both in the later half of the year, will bring in about $4 billion. Right now, you're estimating just about $6 billion from the COVID vaccine. What can you tell us about the market and sort of the change that has happened since, the tens of billions from the COVID era?
Well, it's the thing of what which is moving from a pandemic to an endemic. If I just use myself as an example, in 2021, I got 3 shots because I got my 2 first one to start and then the booster in the fall of 21, when this year I got 1 shot. So it's pretty easy math that the market is resizing to an endemic setting where people are going to need an updated booster. I think there's still a lot of confusion. When you look, there's 150 million shots for flu. There's only around 50 million shots for COVID in the US. And that's quite remarkable, because if you look at the facts, as of last week, there are 22,000 Americans hospitalized for COVID last week. And there were 5,000 hospitalized for flu. That's 4x. You had 4 times more people getting hospitalized for COVID, but only a third of people getting a flu shot, also getting a COVID shot. And those are just the fact that we need to just, as a society, to work through and help people to understand that, people that are in nursing homes should get protected. People that are at risk should get protected. Their risk with COVID is very serious. 22,000 Americans in hospital just last week.
Yeah, that's right. And of course, one of the reasons why you're working on combo vaccines, we know that generally speaking, this isn't new or just unique to you in terms of that pressure in the COVID space, but we'll definitely wait to see what the market looks like next year. Meanwhile, you do also have some changes in the leadership. You are personally now overseeing the commercial process, and I wonder what that's going to look like and why you're taking this on.
I'm taking this on because it's such an exciting opportunity. It's all about the sales growth. We have a very strong pipeline. We have 7 products in phase 3. We have more than 40 products in development. I'm lucky. I have an amazing partner, Stephen Hogg, who has been with me since almost day one, who leads the science. He's really fantastic. And the strategy is very clear. As you just mentioned, the key for us is that we go out of the COVID pandemic into growth again. 24 and 25, as we said in our Q3 earnings call, are really important for us. And as we looked at the priorities of a company, we became very clear with the management team and the board that it would be helpful if we could accelerate the decision-making process, if we could accelerate relationships with key customers. And so I really want to use my time, plus that's a field I know pretty well. My first job was a sales rep, I was a sales manager, I was a country manager. So I've done these type of things, and I want to be very close to the team. I want to obsess about customer intimacy. How do we understand customer need in the retail pharmacy, at the wholesaler, the doctors? How do we position our product? How do we help them help their patients to be better protected? I think it's a great opportunity for us, and that's one of the most important things I can do for Moderna in 24 and 25. Drive a top line, invest the proceeds in R&D. The platform is throwing a lot of products. So it's very exciting.
All right. Well, the boss is back in the building for sure. Thank you so much for your time today, Moderna CEO Stefan Benzel.
And our thanks for that interview, Yahoo Finance reporter Anjali Khemlani. Coming up, we've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Here's a live shot of Times Square.
New outlook. As 2023 draws to a close, brace yourself for a riveting financial look ahead to 2024. Here's what we'll be watching. The soft landing debate. Are we heading for a recession? The AI hype cycle. Is it still real? And the 2024 presidential race. President Biden and former President Trump seemingly set to square off yet again. We'll break down how this election could impact your long-term investments, so get ready to uncover the insights, predictions, and financial secrets that will set the stage for what's expected to be a prosperous new year. Join us for our year-end finale that will leave you both informed and inspired.
Welcome back. You're watching Yahoo Finance Live. We've got some breaking news here this morning as Trian, in its activist campaign with Disney, is now nominating 2 new potential people that they would want to see get on the board, Nelson Peltz and Jay Rasulo. For more on this, let's bring in Yahoo Finance's own Ali Canal. Hey, Ali.
Hi, guys. Yeah, so we knew that Trian was going to nominate Peltz and perhaps a few other members to this board. Now, Jay, he is a former CFO at Disney, worked closely with Iger. It's interesting to me that they are choosing someone that used to be at Disney to now fix the problems that they say are plaguing the media company. Obviously, for CEO Bob Iger, this is going to be probably one of the top things he'll face in 2024. It's that short-term issue that with these activist fights coming out of the woodwork that he'll have to battle. He's said before that he's not going to be distracted by these activist fights, that there are other concerns at the company. But we spoke with analysts who have said, you know, these Nelson Peltz, these other board members that Trian's going to nominate, they are sort of short-term focused, which is what shareholders want. And Bob Iger is more longer-term focused.
Yeah, Ali, I'm curious just to get your perspective on this, because a lot of the criticism that Iger has gotten the second time around is the fact that Disney is in a much different place than where it was when he was first at the helm of Disney. The fact that Nelson Peltz is hiring a former CFO, what do you think that signals just in terms of the strategy and what Nelson Peltz and the Trian Fund wants to see Disney prioritize?
Well, I think what they want to see, the main priority right now is getting the stock price up. How are you going to do that? We've already seen Iger restructure the business. He's laid off 7,000 workers. He's really committed to the park side of the business, $60 billion there. On the streaming side of the business, you also want to make sure that you're profitable and hitting your targets on time. So I think with the CFO focus, and we've seen a lot of C-suite turnover, particularly in that CFO role, I think it's going to come down to cost cutting on the content side, maybe perhaps on the park side, just making sure that you're rationalizing that balance sheet. I think that's really what Trian wants to see in the near term.
All right, we're going to be tracking shares of Disney. As of right now, they're up by about 1.2%. Also, we're tracking this morning. Move over Barbie. There's a new doll making its way to the big screen. Mattel says a live-action movie based on its American Girl doll line is currently in development. The project, the latest in a packed lineup of movies for the company after Barbie's blockbuster success at the summer box office here. All right, we got to talk about this because at the end of the day, Ali, this is where many of the investors want to see even more of the content translate into the big screen, perhaps translate into another form of revenue that companies can generate.
Yeah, this is a big focus for Mattel. They have their own TV studio. I mean, this is something that they really want to do, create these multiple consumer touch points. And it seems like they're just kind of going for these millennial youth. I mean, American Girl, that would hold on me as a young kid. I had Samantha. I would go to the American Girl doll store in New York City. And it makes sense that they want to create this live action film, especially on the heels of Barbie's success. We also have other types of movies coming, like Polly Pocket movie, Uno, Rock'em Sock'em. I mean, any toy you played with as a kid, you probably will see this be made into a movie with Mattel. And this is the American Girl doll one specifically is going to be distributed by Paramount Pictures. Barbie was Warner Brothers, so kind of a win-win for the studios as well.
Yeah, I just think this is a huge win and so smart of Mattel, especially with American Girl doll, because Ali, I'm just like you. I collected a number of those dolls while I was growing up. You tap into that nostalgia, bringing people back to their childhood. It clearly worked with Barbie. We'll see whether or not the strategy continues to work for Mattel going forward. All right, Ali, thanks.
Thank you.
Well, that does it for Brad and I today, but keep it right here on Yahoo Finance. Rochelle Akufo has you for the next hour. We'll see you tomorrow.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Retail sales rebounding month over month ahead of estimates and signaling a still strong consumer. What this shows about the state of the economy. And fashion lawsuit. China's online marketplace Temu has sued rival Shein over what it's calling a, quote, desperate plan to win back business. We've got those details coming up this hour. Plus, star power backing. Oprah is the latest celebrity to admit using weight loss drugs, but how does it impact her stake in Weight Watchers? We'll have that for you coming up this hour. But first, let's take a look at how the markets are faring this morning. Still solidly in positive territory, though pulling back a little bit this morning. The Dow currently up over 100 points, or about 0.33%. S&P 500, they're also up about 0.4%, or about 20 points. We're seeing real estate and energy driving that. Consumer staples, the laggard so far this morning. And the tech-heavy Nasdaq, they're also up about 0.4%, or about 55 points. Well, as the Fed signaled rate cuts ahead, we're seeing what that's doing to Treasury yields so far this morning. We're looking at the 5-year down about 2.4%. He's looking at the 10-year solidly under 4 there, down about 2.3%. And the longest term 30-year yield, that's down about 2.4% as well. Well, the consumer just keeps on going strong. U.S. retail sales in November posting a surprise jump, up 0.3%, where a dip was expected. Here with the sectors that saw the biggest gains and losses is Yahoo Finance's Josh Schaefer. Still spending, Josh.
Yeah, Rochelle. I mean, at this point, we really shouldn't be surprised, right, when retail sales beats Wall Street's expectations. That's been the story for really most of 2023 and certainly through the summer and through Q3. But I want to hit some of the sectors where we saw the biggest gains and the biggest losses in the month of November. So right now you're looking at the overall chart. You can see retail sales up 0.3% in the month of November after that slight decline we saw in October. So we're not trending down. That was a big concern coming into this report. But always interesting to just take a look at what won and what didn't win, especially when we think about November, of course, holiday spending. So some things that did win, you can see there, restaurants, food away from home at restaurants, rising 1.6%. Hobby stores, 1.3%. Hobby stores include sporting goods, e-commerce up 1%, health stores and furniture also up about 1%. But of course, not everything can go up, right? We didn't have that big of a number. Gas stations were down 2.9%. Now, part of that is really because gas prices came down, so that's not necessarily people buying less gas. Department stores down 2.5%. Miscellaneous stores down 2%. Electronics down 1%, which is in that discretionary category, so that's always an interesting one to watch. Department stores down, though, another one to highlight. A lot more people shopping online this year, it seems, from various different data points that we're looking at as far as holiday spending goes. And Rochelle, just the last thing I'm thinking of just overall with this number, one thing we really wanted to see, you don't want to see too big of a number, right? That's when people start to get worried about inflation and we're growing too strong. But you did want to see a little bit of a rebound because we saw that negative print in October. So economists sort of making sense of this print today to say, well, if you take negative from October, slightly negative in October, slightly positive in November, we're sort of just tracking lower than Q3. And that's good when you think soft landing. Remember, soft landing has a little bit of economic growth or slowing down baked into it. So overall, the kind of print we've been talking about in terms of economic data and a positive in terms of the Fed.
It's true, and then especially as we look at factoring in some holiday spending, as that holiday shopping season extends now, through the middle of October. Yeah. But of course, consumers say they're tired of inflation, but they keep on spending. Where is the disconnect?
Yeah, Rochelle, I mean, it's been interesting to sort of follow that throughout really the last several years now, but it seems like part of the disconnect is just what people say about inflation versus what they're willing to pay hasn't really added up. And I think that's led to some of the confusion we've had in the data over the last year. When you look at prices being higher, people saying that they can't afford these prices or that they're getting sick of paying these prices. But then we've just seen the quote unquote resilient consumer throughout 2023. So I think when you look at some of that survey data that you're referencing of people being tired of inflation, I think it just hasn't translated, and it sort of gets us to the larger economic story of 2023, which is, why didn't we see a slowdown? Because people don't like inflation. No one wants to pay more. But right now, Americans seem to be able to find a way to pay more, and that's what's keeping economic growth going, at least for now. Of course, some people still see that slowdown coming in 24, Rochelle. We'll have to see.
It's true. And as they find those ways to pay, looking at those credit card delinquencies continuing to tick up, the rubber's going to hit the road at some point. Appreciate you, our very own Josh Schaefer. Well, as we mentioned, the consumer is still spending. November retail sales posted surprise growth, signaling U.S. shoppers remain in a better position than feared. But just how long into 2024 could it take consumers to start feeling that spending fatigue? Let's bring in David Tinsley, Bank of America Institute senior economist, to weigh in here. So we touched on this, about this dichotomy about why consumers are still spending, not necessarily on the necessities as was first the case. What is happening here?
Well, I think as your report was just saying, there was strength in the retail sales numbers in November. And interestingly, when we look at our data at Bank of America Institute that covers our 69 million customers, we see strength not only on the retail side, but also in the services side that the retail sales data obviously don't cover. So in the run up to to Cyber Monday and Black Friday, we saw strength over that period in airlines, and also in event tickets, for example. So it's not just a story about good spending, retail spending. I think the big thing that's happening is the labour market. So, you know, your report was touching on the fact that people hate inflation. Of course they hate inflation, but if they're getting a pay rise, then they can afford at the end of the day to cover those price increases. So it's a labour market story that's powered the consumer by and large this year, I think.
And as you've noticed, some of the labour market trends now broadening throughout different, whether you're low income or higher income, how is that impacting what we're seeing now?
Yeah, that's an interesting point. So basically, we can look at the pay rises people get in our data when they change jobs. And we are seeing a slowdown there. We're seeing that during the Great Resignation, people were getting 20% rises when they changed jobs. And that's now settled down at about 10%. But that's roughly where it was before the pandemic. So there is a slowdown. It seems more concentrated at the younger generations, the young, than the older generations. But really, at the moment, it's not really a sufficiently large slowdown to put the brakes on consumer spending, which, you know, as you were saying, really has been strong all year, and also supported, I think, by the fact that these deposit buffers that we discuss are still up sort of 30% upwards relative to pre-pandemic. So people still feel relatively comfortable, I think.
And David, I want to dig into how different demographics are spending, because we talked about younger consumers here. And in your data here, looking that they're more cautious in their holiday spending than baby boomers. You also have Gen X and millennials, you know, really honing in on some of these promotional periods. How does that factor into what we can expect into 2024, especially as some of these bills come due?
Yeah, I mean, the jury's out really on spending over the holiday season for the generation. So what we noticed was that the older generations were spending firmly throughout November on holiday items. The younger generations were holding back until the holiday weekend, and then they ramped spending. And in a survey we ran, we found actually that the millennials weren't particularly planning on cutting back their holiday spending relative to last year. So the jury's out. They may come good, if you like, and keep spending throughout December. I mean, looking to next year, I think what I say is the fundamentals remain broadly in good shape right now. The labour market, as we discussed, has slowed, but is certainly not slowing precipitously. The deposits, the savings and checking account cash that people have on hand to support their spending is coming into the new year in, you know, relatively high still compared to where it was before the pandemic. So across the piece, there's support. There are headwinds, I think, that particularly hit the younger gens. So I'm thinking here of student loan repayment, utility bills, childcare costs up 30% or so relative to pre-pandemic. So that particular cohort getting hit quite hard there. Renters, of course, have suffered pain in the past. So I think the headwinds are blowing harder on the young, but the overall picture is pretty solid.
And so, David, as we look ahead to 2024, and obviously still waiting for all of the medicine from the Fed's actions to trickle through the economy, what do you think are some of the key things you'll be watching for in consumer behavior?
Well, I guess, I mean, really how these headwinds play out and how the consumers cope with them. So at the moment, when we look at our data, we can look at people who are making student loan payments, have a look at their spending, and we're not seeing any real significant signs of a pullback. So that's good news. But of course, there's a ways to go in that story. Some people are making use of the administration's on-ramp and haven't started paying yet. And then all these other cost factors I was mentioning, childcare costs, utilities, etc., they will come to pass. I mean, I think at the end of the day, it's going to be down to the labour market. If the labour market slows in a sharper way than most economists are expecting, then I think there'll be more pain. But at the moment, from our data, things are fairly benign, I'd say.
Sure, and still, some healthy savings there, perhaps a little bit of doom spending as well, heading into the winter season. Appreciate you joining us this morning. David Tinsley, Bank of America Institute Senior Economist. Thank you. All right, let's get to today's trending ticker. Rivian shares popping after announcing a team-up with AT&T. Now, the wireless carrier is purchasing a fleet of electric vehicles from the startup as part of a pilot program to find ways to reduce cost, cut carbon emissions, and improve safety for AT&T's workers. Now, the two companies haven't announced the number of vehicles being purchased, but AT&T said in a statement that it plans to add some commercial electric vans, R1T pickup trucks, and R1S sport utility vehicles in its fleet in early 2024. Now, this is the first deal for Rivian since it ended its exclusivity pact with Amazon last month, the share price being rewarded so far this morning. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Wall Street and the Fed are on the same page, kind of. Well, for the first time in a long time, market expectations and the words of Fed Chair Jay Powell largely harmonized. The Fed indicating multiple cuts are coming next year, though it also warned it's, quote, far too early to declare victory. Shares spiked, bonds surged, and global currencies rallied anyway. But are we getting carried away? Let's bring in FM Investments President and Chief Information Officer Alex Morris to get his insights. Good to have you on the show here. So I want to first get your initial reaction, obviously, from what we heard from the Fed yesterday and sort of this digesting of the information today.
Well, I think the Fed made Chair Powell in particular made very clear. We're not declaring victory yet, although a few of the dots on the dot plots may have declared victory and just haven't said anything yet. But I think you're absolutely right. This was a sudden change in tone from the Fed, and they made very clear that they will continue on this plan, that it has been working, and that's an important point. I think Chair Powell made a good point when asked about the value of forecasts, was that most of them had been calling for doom and gloom and recession for the last 18 months, and they'd all been wrong. And he's probably right to say we shouldn't trust those same folks to get it right in 2024. But on the whole, the policy that has been set forth, the rate rises, have worked. I think the key in the messaging, though, is that it was fairly obvious what needed to be done. Rates needed to come up to get the inflation number, which was far beyond target, back into line. But now that that's coming into line, the real hard work starts. How do you now tweak all of the various tools, whether that's the Fed funds rate, whether that's quantitative tightening, and some of the other items they have at their disposal, to not reduce rates too soon, to not cause a recession by waiting too long or by easing conditions too quickly. So it'd be very interesting to see how they tackle this in Q1 and Q2. But the hard work's ahead, and I think Chair Powell forecasted that very well.
And you're expecting more so the cuts to come in late 2024. What do you think is going to signal that?
I think the first signal will be that the job market will start to weaken, which is the next half of the equation for the Fed, right? They will get inflation close enough to target that they'll feel their work is done and that they're not going to hike anymore in an effort to slow the rate of inflation. But they also don't want job stability to weaken too much. You know, last year and a half ago, the problem was there were too many jobs and too few people. As we start to ease that balance, that one I think is where we become far more sensitive. If the unemployment rate spikes up a point, that's far worse than the inflation rate spiking up a point suddenly. Because it's much harder to switch those around, to get folks to take new jobs, to reset to new wage levels. And the Fed was going to start focusing more on that number Q1, Q2, and a surge in unemployment or JOLTS numbers will be the first catalyst for some intervention.
And so then, as we're looking ahead then, if you're an investor, you heard this dovish tone from the Federal Reserve, still not sure exactly when we'll start seeing these rate hikes start appearing. But in terms of investment strategies, is it about the 60-40? How do you pivot from here?
So we've never declared the 60-40 dead, despite many others trying to do so. And I think if you were well exposed in a 60-40 portfolio, you were pretty pleased with results across the board yesterday. Bonds are certainly poised to have a great 2024 across the board, across investment grade, high yield. We think it's a great time to be in that 60-40 portfolio. And that said, although everyone has spoken so highly of the Magnificent Seven, there's nothing wrong with having a broader exposure in 24 as the rising tide will start to lift all boats in a more meaningful way.
And Alex, we know that we saw this knee-jerk reaction from markets lifting a lot of stocks beyond the Magnificent Seven to 52-week highs. How do you determine which are the ones, when all of this sort of exuberance shakes out, which are the ones that people should be focusing on? What strategy should they use?
So we think that in the short run and probably midterm, we like stocks that show momentum, and not just momentum in price, because everyone seems to be seeing that the last few sessions, but momentum in the underlying business model. So that tends to be, in particular now, things that are still more tech focused. So not purely the Magnificent Seven, but some of the players that surround that. Some of the information services names do pretty well. And now I think some of the retail space is going to become attractive as well. And you want businesses that are really set to capitalize on whether it's static consumer spending or just a business that already was doing well, that now with improved economic conditions and the looming threat of recession removed, can really just springboard itself into that next level of its business model. And we think you can find those by looking at things that are constantly growing top line, growing bottom line, and that show a commensurate share price improvement when you see those quarterly reports come out that show improved underlying financials.
And I mean, we've seen a lot of volatility with every data point that has come out. But as we head into 2024, of course, it's also election year as well. What do you see as the potential biggest headwinds that investors should be looking at versus the ones that will be creating the most buzz?
Yeah, I think the problem is for investors will be, there's going to be a lot of data as always, but now there isn't going to be a single direction to interest rates or a single sort of view of the market. It's now going to be very important to pick and choose where you want to be positioned. And sometimes the best solution there is to step away from minute by minute, second by second views of how you should be positioned, and really slow down and look at what is the long-term implication of how we're going to go into the election cycle. And I think the driving factor, though, will continue to be the Fed's policy and the employment market. And looking at that, I think that's where that fair blend of your more growth-looking stocks and then a still relatively healthy dose to the fixed income market and not giving up on the short and middle end of the curve, where you're still earning a material return. Still 4 3/8 to 4.5% of coupon income is something that 2 years ago was almost unfathomable, hadn't happened in a decade. So I think investors should still be happy with that as we wait for Fed cuts and timing to really start play out next year.
We'll certainly be tracking that closely. I appreciate you taking the time to join me this morning. FM Investments President and Chief Information Officer, Alex Morris. Thank you so much. Taking a look at General Motors' driverless cruise division laying off 24% of its workforce this morning. The news comes after 9 executives were ousted from the team and a few months after the company's robo-taxi fleet suspended operations following a series of accidents. In its layoff announcement, Cruise stressed safety would remain its North Star as it works to build a path forward. All right, well, it appears that there's some good news for some apartment hunters. Manhattan rents fell annually in the month of November. Now, this marks the first time in over 2 years that prices have dropped. According to data from Miller Samuel Inc. and Douglas Elliman Real Estate, new leases that were signed in the last month hit a median of around $4,000. That's a 4.6% drop from October and 2.3% lower than the month of November of 2022. Now, New York is still one of the states with the highest median rental price. According to a report from Rent.com, Boston, Massachusetts, San Jose, and San Francisco, California are other metro cities with high median rents, all over $3,500. Oklahoma City, though, came in with the lowest, with a median rental of just under $1,200. Must be nice. All right, well, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
New year, new outlook. As 2023 draws to a close, brace yourself for a riveting financial look ahead to 2024. Here's what we'll be watching. The soft landing debate. Are we heading for a recession? The AI hype cycle. Is it still real? And the 2024 presidential race. President Biden and former President Trump seemingly set to square off yet again. We'll break down how this election could impact your long-term investments, so get ready to uncover the insights, predictions, and financial secrets that will set the stage for what's expected to be a prosperous new year. Join us for our year-end finale that will leave you both informed and inspired.
COP28 ended with a bang as 200 countries agreed for the first time to transition away from fossil fuels in a major move to combat climate change. The president of COP28 praised the deal, but stressed the need for nations to follow through with tangible actions. So could nuclear energy finally get its chance to shine in the wake of this agreement? I have Yahoo Finance's Rick Newman with his thoughts. So Rick, I mean, a lot of people thought we weren't going to be able to get all these countries on the same page here, but help us manage expectations.
Yeah, sure. So there was a side agreement at this UN climate conference where 22 nations led by the United States said they pledged basically to increase nuclear power production by 300% by the year 2050. And the reason this caught my eye, Rochelle, is every time I talk to energy economists about how do you get to these targets, these climate targets, reducing emissions and getting to something like zero carbon emissions from the power sector, just about everybody says you need a lot more nuclear power to do this. So I've been looking into this. I mean, the plus of nuclear power is it's a lot safer than people think. There is literally no pollution in the generation of the power. And of course, it's efficient, but it's not being adopted as fast as a lot of advocates would like because it's still expensive. There are some subsidies for nuclear power in the Green Energy Subsidy Act that President Biden signed in 22. But it's just still not coming to market. And without nuclear power, you really you cannot install enough wind and solar production to get to these climate targets and slash emissions as we need to do, because the problem with renewable energy is you can't store the power. It is not cost effective to store the power. You have to use it as it is generated. And that means that when the wind is not shining or the wind is not blowing or the sun is not shining, you need something else. And for now, that's natural gas and coal. Nuclear power would be a great way to replace natural gas and coal. It's just there are regulatory hurdles, cost problems. So there are people who would love to sort of establish some breakthrough here. We're just having a tough time getting there.
And Rick, we know that there's an appetite from people like Elon Musk, some politicians, but in terms of consumers, this idea of having nuclear energy and this whole not in my backyard, how does that play into how far nuclear energy can go?
Well, there's one very interesting idea, which is to take a lot of the coal plants that are the dirtiest, that's the dirtiest form of fossil fuel, and we are retiring coal plants, and to actually put nuclear facilities, nuclear power plants, right on those same locations. You could use some of the existing infrastructure. It's already connecting to the grid, for example. A lot of the workers at the existing power plants could work at a nuclear power plant. Some of them would need new licensing, but not all of them. Some of them would just be able to go over to new jobs. And it's still not in anybody's backyard. You're not putting that in anybody's backyard. People do have concerns about the safety of nuclear power because we all remember something bad happened in Chernobyl, something bad happened in Fukushima in Japan in 2011 when there was a tidal wave, and then there was 3 Mile Island, I think back in 1979. If you look at the safety record of nuclear power, it actually is vastly safer than fossil fuels when you account for air pollution and all the harm, the deaths and the illnesses caused by air pollution. I mean, there is no air pollution from nuclear power. So people need to understand that there's new technology that is much safer. Reactors are actually a lot smaller these days. There have been some breakthroughs in terms of the size of these reactors. But we just have a long way to go in terms of actually deploying these things, getting through the regulatory process, adapting the regulatory process for the new technology because it's still geared toward old technology, and then getting the cost down. So we may need government help if we're ever going to adopt a lot more nuclear power.
And certainly having to be creative in this transition to cleaner energy here. Appreciate you breaking all of that down for us. Our very own Rick Newman.
See ya.
As we mentioned there, COP28 ending on that historic note, almost 200 countries agreeing for the first time to transition away from fossil fuels in a major move to combat climate change. But how does this deal impact energy markets heading into 2024? Yahoo Finance's Ines Ferrer has that breakdown for us. Hey, Ines.
Hey, Rochelle. Yeah, well, as we talk about the price of oil and the volatility that we've seen with the price of oil, even though you're looking at oil in the 70s, you still have forecasts for oil going into the 80s in next year, as you are expected to see an uptick of demand and also, but you are seeing, though, a supply increase. Look, it's no surprise that the industry is all countries are really transitioning, that they are trying to move away from fossil fuels. You still need, though, fossil fuels for that energy transition. But from this meeting, from COP28, as one oil executive from Shell put it, he said the most actionable commitment at COP28 is the target to triple global renewable capacity by 2030. So that is where it's at. It's the growth in renewables. And we have been seeing more and more energy companies that are increasing their investments in renewable. We saw ExxonMobil that is going to be drilling for lithium. They also are involved in carbon capture. You've got European oil companies that are involved with solar and with wind. They know where all of this is going. They are energy companies overall at the bottom line of it all. And that means whether it's fossil fuel or whether that's a renewable energy, they are also in the energy game as well. But look, straight up, you are going to see renewable energy companies that are going to benefit from this. They are benefiting from tax credits from the IRA here in the US, the Inflation Reduction Act that was passed last year. And they have had struggles. I'm going to pull up our Wi-Fi interactive board so you can see where we are at with some of the clean energy stocks right now. Today, we're seeing a big bump for them. But year to date, you can see some of the struggles that they have had over this past year because of the higher interest rates, because of the higher borrowing costs, because of the cost of labor that has gone up. If the Fed pivots next year, you will see an easing of monetary conditions. So that will be bullish for the clean energy stocks. But look, the industry is changing rapidly, and the traditional energy companies like the big oil, we have been seeing a big consolidation where it's concerned there in the Permian Basin. We're also going to see them increase their investments when it comes to renewable energies, perhaps even scooping up, perhaps also some of the renewable startups or companies.
We'll certainly be keeping an eye on the demand for fossil fuels amid this green transition as well. Appreciate you joining us, as always, Ines Ferre.
Thank you.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Chinese-owned e-commerce giant Temu is suing rival Shein again. Whaleco, which operates as Temu in the US, is accusing Shein of a host of illegal business tactics that allegedly undercut its business, even threatening merchants. To tell us more, Yahoo Finance legal reporter Alexis Keenan is here. I mean, some of these accusations accusing of mafia-style intimidation of suppliers.
Hardcore competition tactics here, Rochelle. So yeah, these two Chinese-owned companies, they are both online retailers, both new to the U.S. markets and fierce competitors. They're back in U.S. courts again after dropping cases against each other back in October. Now, this time it's Temu, which is owned by Chinese public mega company PPD Holdings. They say that Shein, in this 18-count complaint, that they have this wide range of claims saying that the company violated copyright infringement laws, also antitrust violations, trade secret violations, unfair competition laws broken, they say. Also contract interference. Now, Temu says that the way Shein is doing this is that it is pressuring suppliers. These are suppliers, merchants that the two companies compete for in order to create their products, pressuring them into not dealing with Temu. There are allegations here that the company, that Shein is using illegal methods to do this, to carry this out. Now, take a listen. This is what is really the meat of the complaint. They say that the company is physically detaining and threatening suppliers, withholding their computers, their phones, their mobile devices, stealing merchant accounts and passwords, also stealing business trade secrets, also forcing them to sign exclusive agreements against their will. Some of these allegations say that these suppliers are being coerced to come into Shein's offices and that they're being detained there until they do what Shein wants them to do. Now, we have not yet heard back from Shein or Temu about these allegations, and Shein has not had an opportunity, because this is a brand new complaint, to respond in court. But this clash can really be better understood by looking at Temu's gain recently in the U.S. markets over this past year. Now, Shein, for its part, they entered the U.S. market back in 2017, so they've been here a bit longer. But they confidentially filed, according to Reuters, for an IPO in November with a target valuation of $90 billion. Now, Temu is doing a bit of upsetting to that dominance. They entered the market just last year in 2022, and they, as of February, were the most downloaded app in the United States. But one thing to note also is that this is all happening under the watch of U.S. officials compiling reports about both companies, expressing concerns that there are illegal hazardous goods being sold on the platform. Also concerns about what the companies are doing with U.S. user data, with their personal information. And also concerns about forced labor, worrying that these goods are not being produced in accordance with U.S. laws. So a lot going on here. Still more to play out with this suit. It's a brand new one, but these companies have been at each other's throats for at least the last year. Rochelle?
It's interesting to see that roller coaster of filing and then dropping and then refiling. Certainly doesn't seem to be going away anytime soon. Appreciate that update. Yahoo Finance reporter Alexis Keenan. Thank you. Well, M&A in the Permian Basin is breaking records this year. Now, the value of merger and acquisition deals in the oil-rich region in West Texas and southeastern New Mexico hit a total of $100 billion in 2023 alone. That's according to a report out this week by Wood Mackenzie. And this comes after Warren Buffett-backed Occidental Petroleum acquiring gas explorer Crown Rock for $12 billion this week. Now, with rates holding steady and the street betting on cuts by March, how are business leaders addressing mergers and acquisitions in the new year? Well, according to a new report out today by PwC, companies may begin to look at alternative deal structures. For more on this, Colin Whitmer, PwC's US deals leader, is here. Thank you for joining me this morning. So talk about these alternative structures. Of course. Talk about these alternative deal structures, especially as we consider the pressure that we're seeing from regulators.
Right. So we've seen clients get pretty creative in the way that they start to execute on transactions. We've seen transactions where it's up to a 49% interest so that the former private equity client could cash out a bit. You could preserve the capital structure so that you wouldn't have to refinance the debt, and then you can do another transaction later on. We've also seen precursors to M&A like strategic alliances, joint ventures, even licensing agreements, sort of put your toe in the water, get a little bit more familiar with your partner, and then have that be a precursor to a larger transaction when the rate environment is more stable and improves.
And as we're looking at what we're seeing in the Permian Basin, what is it about that region? Is it just an energy story as we look at some of these large mergers and acquisitions versus sort of these smaller ones that are up and coming for 2024?
Yeah, I think it is largely what you just described for the Permian Basin. But if you think of our other corporate clients, M&A for them is basically business model reinvention. It's the quickest way to do it. Our clients that use transactions to transform their business, whether it be because of climate change, technological disruption, demographic shifts, a fractured world, social instability, put all that together, businesses need to reinvent their business model, and M&A is the fastest way for them to do that.
And usually, we've been talking a lot about recession here, and that's usually, prime time to start seeing this. Obviously, we're still not there at recession. The Fed might stick the landing. What does that mean for the types of deals that are going to be more popular going into the new year?
Right, and I think you're right. The jury's still out whether or not we'll have the soft landing, but it does seem as though things are trending that way. We are nearing the end of a profit recession. So if you looked at the S&P 500 EPS growth, we had 3 straight quarters of decline, but that has changed in the second quarter of 2023, and it's expected to continue. So that bodes well for M&A. Large transactions, I think, will still be challenging to get done, in particular with the antitrust backdrop that we've seen and how aggressive the U.S. government has been around antitrust actions. So very large transactions, I think, may take a little bit of time to come back, but there's lots of tuck-ins that our clients are planning to do right now just to transform their businesses.
And you note that tech, media, telecommunications, we're seeing those usually the most active sectors. Will that still be the case in 2024? We've also seen some action in the health space as well.
Yeah, and tech has always been one of the most active areas for M&A. I think it will continue to be active, probably not for the very large transactions and large companies because of what I mentioned about the regulatory scrutiny. But private equity is still very active in software as a service businesses and tech, as well as getting into things like cybersecurity. So I do believe tech will still be good. I am smaller deals in pharmaceutical and life sciences will continue to happen. And then, of course, health services, which is sort of one of the least susceptible to the economic conditions. So those will always continue to be attractive assets as well.
And of course, tech, a huge space indeed. And we know AI, of course, stole most of the headlines so far this year. So as we look at some of the nuances within tech, and when we think of not just what US regulators are doing, but also European regulators cracking down as well, how do we see that affecting IPOs as well?
Yeah, the IPO market has been very muted for a while now. There were a couple of large IPOs that came out, but we haven't seen the floodgates open for the rest. So there is a big pent-up demand for companies to go IPO. Not exactly sure when we'll see that market open up. Hopefully it opens up in 2024, like I suppose the rest of M&A will open up as well. And as it relates to AI, all of our clients are interested in artificial intelligence really from 2 perspectives. One, are they buying a business that could be easily disrupted by artificial intelligence? And then secondly, how could they improve their businesses using artificial intelligence? And you get that really in spades from the private equity side of the business.
And especially for some of these more sensitive parts, obviously we're still in the very early stages of just how much some of these large language models will impact that. What does that mean when you think of things like national security now increasingly being tied into some of these deals as well?
Yeah, there's CFIUS has been an issue, and the U.S. government has been very critical of certain types of transactions where U.S. companies are moving things offshore or acquiring things offshore. I think that scrutiny, the CFIUS scrutiny on top of the regulatory backdrop of antitrust are just going to weigh on M&A for a while until that settles down.
We'll be keeping an eye on that as well. Thank you for joining me this morning. Colin Whitmer, PwC's U.S. Deals Leader. Thank you.
Yep, thank you, Rochelle.
All right, stay with us. We have all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
New year, new outlook. As 2023 draws to a close, brace yourself for a riveting financial look ahead to 2024. Here's what we'll be watching. The soft landing debate. Are we heading for a recession? The AI hype cycle. Is it still real? And the 2024 presidential race. President Biden and former President Trump seemingly set to square off yet again. We'll break down how this election could impact your long-term investments, so get ready to uncover the insights, predictions, and financial secrets that will set the stage for what's expected to be a prosperous new year. Join us for our year-end finale that will leave you both informed and inspired.
Weight Watchers is stepping into the weight loss drug game. The company launching a new program today geared towards supporting people who use weight loss drugs. Now, the news comes after Weight Watchers spokesperson Oprah Winfrey revealed she's been using weight loss medication. Dr. Palmer joins me now with more. I remember looking at pictures of Oprah at that Color Purple premiere, and I was like, she looks fantastic.
She truly did. I was in awe of it as well. That purple dress looked amazing on her. And now, of course, she also did come out with the news that she is using a weight loss drug medication, but she did not specify exactly which one. And now it's also important to note here that Oprah Winfrey has been a board member of Weight Watchers International, WWE International, of course, formerly known as Weight Watchers, since 2015. She also has an $8.29 million stake in the company based on Wednesday's close. And Weight Watchers really here trying to jump on the bandwagon of what really, according to Yahoo Finance, has been the biggest story of the year, weight loss drugs. WWE International spokesperson telling Yahoo Finance this morning that this new GLP-1 program is to help consumers who are on GLP-1 medications manage the unique behavioral needs they face while managing life on medications. Now, As you see here, some of the tools of this new program is to ensure that consumers on the drugs have adequate nutrition, specifically protein and nutrients-dense foods, as well as hydration. They also are offering daily nutritional activity targets, a list of GLP go-to foods, recipes, trackers for weight, activity, and food, among so many other tools with this new program. Once again, for people on these GLP-1 drugs. And also, this comes as Novo Nordisk, one of the providers of weight loss drug medications like Ozempic and Wegovy, is getting a pop this year, up 45% gain on the year, and that outpaces the S&P 500, which only has been up 19% year to date. And so lots of momentum heading into 2024 behind these weight loss drugs.
And interesting to see it sort of paired with a weight loss program versus sort of people using it as a quick fix. And so, Brooke, Weight Watchers also offers users access to GL1P prescriptions through its online telehealth clinic. What can you tell us there?
Yeah, Rochelle. Well, Weight Watchers, or WW International, acquired Sequence, a telehealth clinic, earlier this year as they really tried to become a digital health company. As they try to move forward in this future where they're trying to move away from that diet culture and ultimately move towards a digital well-being health company. And ultimately, WW International did tell me this morning that this latest GLP-1 program is not to help patients wean off medications, but it does offer other programs like its points program, which tracks calories and nutritional value of different foods, largely what Weight Watchers is known for. They also added that should users of these drugs want to get off with the help or a decision that's made between its patient and their clinician program, then it does have other programs there to help it. But with this new program, they are able to prescribe medicine to users, but Weight Watchers really falling back on what they're known for, saying that should the patient and clinician make that choice, then they also have the points program to step in. And I also want to note WW International up on this news today. It did pop 10% at market open.
I mean, certainly always good to have some options. And of course, when you have a name like Oprah Winfrey behind it, you know that's going to get some attention. Appreciate you. Brooke De Palma, thanks so much. All right, well, let's get your final check of the markets as we head into the noon hour. Still looking at green across the board here. The Dow picking up a little bit of speed, though it has been oscillating quite a bit so far this morning. Up 112 points, or about 1/3%. S&P 500 there also up about 0.4% or 20 points. Tech-heavy Nasdaq also up about 50 points on the day, or about 1/3%. We're seeing that rally broaden beyond the Magnificent Seven on news of those Fed potential rate cuts for next year. Well, that does it for now. I'm Rochelle Akufo. Stay with us on Yahoo Finance.